City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
The jobs report last month beat estimates.
That is a stunning number.
That is what nobody was expecting.
The bullish train has left the station.
This is what Powell does not want to see.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
You're really not seeing the level of restrictiveness show up yet in the labor market.
Significant job growth and high labor force participation.
There's a very strong chance that the market is mispriced for 2024.
The December jobs report, Friday on Bloomberg Television and Radio.
Just a few days ago, we issued what will be the last drawdown package, security assistance package for Ukraine that we have funding to support. So it's really important when Congress comes back to work here next week that they get our supplemental funding approved and passed so that we can continue the flow of necessary weapons and capabilities to Ukraine.
Two big deadlines coming up over the next 6 weeks. That was John Kirby, the National Security Council spokesperson, speaking on ABC over the weekend, live from New York City. Here's the price action for you to kick off the trading week, the trading year. Equity futures pulling back by 0.7% on the S&P 500, just a touch lower. Apple in the pre-market off the back of this downgrade from Barclays. Tim Long leading that effort, saying we believe the continued period of weak results coupled with multiple expansion is not sustainable. That stock pulling back 1.71%. I've got to say, Lisa, no drama in the context of the massive gains we've seen in the last 12 months. But certainly, I think that's the question a lot of people are asking already coming into 2024.
Which is the reason why people are responding to a rather ambiguous recommendation to Tom's earlier point about what it even means to be underweight. But what this highlights to me is the fragility of the S&P's level to Magnificent Seven stock performance. How much that is the deciding factor and how much of a mystery that is heading into a year where a lot of people expect it to sort of trade sideways. How often does that happen?
NASDAQ 100 futures pulling back by almost 1%, of course. The biggest weighting on that is Apple, TK. Apple last year up close to 50%.
You know, you lined up, John, as you did with the equity, you can line up the returns. You mentioned NVIDIA as an outstanding event last year. And the question is, what do the mainstream tech companies, Microsoft, Apple, and them do? And also the ones that are more at the margin. And then I'm fascinated by what nonprofit tech does. Goldman Sachs follows this carefully. And it had a bang-up end of the year. Does that continue with these companies with non-profit?
I love the idea that nonprofit tech means something different to different people. It's not someone who's going out of their way to do good. It's nonprofit, meaning no profits.
Yeah, you know,
just clarifying for anyone who is confused.
It'll be part of our discussion. Again, a highlight today, John Stolf is scheduled to be with us in the 8 o'clock hour. He's been right, and he is bullish, always optimistic. Is Amory Horton, Bloomberg Washington correspondent, joining us desk side here today. I'm going to go to the border first, and the idea of the immediacy of do something. Define do something for the administration after the border dialogue of our sojourn, our Christmas sabbatical.
Well, it's going to be an important topic this week because we have the current Speaker of the House, Mike Johnson, going to the border, going to Eagle Pass, Texas on Wednesday. He's bringing a large congressional delegation with him. And all of this is happening while we still don't have an agreement on the border. And what you just heard from Admiral Kirby, when it comes to Ukraine funding, when it comes to Israel funding, Taiwan funding, all of that is being linked to the border. At the same time, we also don't have funding agreement when it comes to top line funding figures. So we have these two potential fiscal cliffs coming up, the 19th and the 2nd, for different parts of government agencies that are going to be running out of money on those days. At the same time, they're trying to secure this massive supplemental package that is going to be money for a lot of foreign policy issues that the Biden administration wants, as well as money for the southern border, but also really what Republicans want is more tighter immigration controls, whether it comes to asylum or it comes to parole. This is where the conversations are. But the most important thing you need to know is no one is back in Washington this week. They all come back next week. So it's very difficult when you look at the timeline and the calendar, trying to figure out how they get this done.
I got 8 ways to go here, but to give it some historical impact. I got Carlos Gutierrez, a Republican, former Secretary of Commerce, and I got Ted Kennedy of Massachusetts, and they're apart, but they're together on an immigration debate well over a decade ago, and it went down in flames. Is the debate any different now than then when it went down in flames?
Well, it is curious that they think within a few weeks they can get an agreement on something that they've been discussing for decades. This is, as you say, Tom, generational debate. But potentially, they could get something done because push is coming to shove when it comes to the timeline on getting something done on the border, especially with what you're seeing over the weekend. You're seeing migrants being dropped off in New Jersey because of some law that Eric Adams enacted, some policy. They cannot be dropped off directly in New York City. There's a lot of pressure as well from Democratic cities and states on this administration. A deal potentially is there. Everyone says, you know, it's darkest just before a deal is done. And potentially because the Freedom Caucus members on the House side are going to nitpick anything the Senate sends them, it might be easier for everyone if it's done just before the deadline.
Isn't this the big change in the last 12 months? There has long been a story where Democrats have been able to say there isn't a big issue here because it hasn't been the issue of blue states. It's now on the doorstep in those blue states, in those cities, in New York City and elsewhere as well. How are local, state officials, regional officials squaring up with the White House's message and what the administration in D.C. is saying about it?
Well, the administration sent out a letter to Congress on top of asking for aid to Israel, Ukraine, foreign partners like Taiwan. They asked for more money also being sent to the southern border. This was a big issue for, say, Governor Pritzker, for, say, Governor Hochul, writing letters, calling on the administration. Mayor Eric Adams being very vocal about the failure of this administration when it comes to immigration and migrants at the southern border. Thousands of people crossing into the United States every day. The issues the Republicans have is not the funding going to the southern border. They're actually talking about making it harder for migrants to come into the United States, making it easier to deport them, making it harder for asylum seekers. And this is where the debate is really an issue. But definitely at this point, there's a lot of pressure in this administration from those blue states that something needs to be done.
So how much urgency is there on the behalf of the administration at a time where we are talking about thousands of people coming in and a real question about how certain states are going to pay for it?
Well, there's a lot of urgency, especially because we're in an election year. So the Republicans are also not going to want to give too much of a win to the Biden administration this year. So there's very little that can get done this year in Congress. It's the second half of this session. They have to agree on funding, and they're going to have to get the supplemental done. I think after that, there's nothing else that's going to be able to happen. Republicans on the same side that want to keep their seats potentially don't want to give a win to the Biden administration, but they have to go home with some sort of prize in November when it comes to re-election.
And we are getting close to New Hampshire, and we're getting close to some of the early primaries. How much is there discussion in Washington right now about a different vice presidential candidate with Joe Biden?
That's not a discussion in Washington. I think that's a big discussion around Wall Street, around people who think, you know, can you just flip up a ticket?
Well, we're all looking at the polls
well,
thinking something's got to change, right?
Well, at this moment, no, that's not happening. That's not a discussion.
Are the polls getting worse?
I mean, for President Biden, they've been pretty dim. I was going to say dire, but dim, dire, gloomy for him. They are getting worse for him, I would say. But again, they are sitting on a huge war chest. And at some point in the next few months, they're going to start to deploy this. And we have to see if it's going to work.
Can we see some more engagement from them? I saw the president complaining about how the media has reported on the U.S. economy. And I can't think of how many interviews he's done on the U.S. economy. Isn't it pretty easy to get that airtime for the president? They can reach out to any network, offer an interview on the economy, and they'll take them. We'll take it whenever you're ready. And yet they complain about the coverage of the U.S. economy. I don't get it.
I feel like you're baiting me because you saw my picture at the White House press Christmas party and said, what did you say to Biden? I said, I'd love you to do a Bidenomics interview on Bloomberg TV.
Precisely.
They have,
yes?
The answer was a wink. So not exactly a yes, not a no.
Wait, what, from Secret Service showing you the door?
I don't
Pretty much.
understand it at all. They're responsible for their own marketing, not the media. And when you put out nonsensical tweets like the ones we've had on inflation from this administration over the last couple of months, that's not helpful. The data is in their favor at the moment. The trends look decent. Disinflation, unemployment. It's their responsibility to engage the media and have those conversations. I don't see that from this administration at all.
Well, they will put out Secretary Yellen from time to time. She does do a lot of speeches as well. And of course, you have Jared Bernstein out of the White House on the North Lawn, frequently briefing the press and going on interviews. The issue is the Americans, people are still not feeling it when it comes to inflation. And their big issue is that the economy is #1 priority. Poll after poll, this is what the American voters care about.
The media should not be the marketing wing of the White House. I'm not sure what the disconnect is about.
Well, neither does anybody else. If you've read all the reports about the vibe session, the mystery of the vibe session, why is it? And all economists are saying we have no clue. I don't know.
I want good vibes for 2024.
Good vibes?
Thanks.
I'm offering you plenty of good vibes.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Equities on the S&P 500 shaping up as follows this morning. Good morning to you all and a happy new year. Equities lower on the S&P. We're negative 0.66%. Call it negative 0.7. On the Nasdaq 100, lower by almost 1 full percentage point. Responsible for some of this move. Thank you, Apple, and thank you for the downgrade over at Barclays. Apple in the pre-market, Lisa, down by 1.8%, almost 1.8% lower. A move to underweight from equal weight. The iPhone 15 has been lackluster. We believe the 16 should be the same.
Just to point out that the Magnificent Seven stocks account for some 28% of the overall S&P weighting. So if you start to talk about the significance of these stocks and the reason why we're focused so much, that's why. There goeth one name, there goeth the whole index, and that's sort of what we were set up for in 2023 and maybe 2024 as well.
I got an overlay on Tuesday as well, which is we've got a lot of data Wednesday. Thursday, Friday, and I wonder if we're adjusting as well today away from Apple and away from equity markets to a little bit of angst about what we see, particularly on Friday with wage dynamics.
Apple is 9% of the NASDAQ 100. It's the #1 weighting, and that's why the
I
NASDAQ
did not know
100
that.
is
9%.
lower by about 1% this morning. The NASDAQ year-to-date last year on the year to performance, a gain of 54% on the NASDAQ 100. Let's turn to the bond market. Big moves lower in 10-year Treasury yields in November, again in December. This morning up by, let's call it 7 basis points, 395.38. Are they talking about cutting rates? They're not talking about cutting rates. Are they kind of talking about cutting rates? Lisa, look out for the minutes in the next 24 hours.
And will that determine anything or just be a further mockery in terms of where the credibility lies? Look, the bottom line is there has been a disinflation narrative that has gotten very far baked into market expectations. How low is the bar for that to shift? Was it in the wage data? Is it in the oil prices? Is it in something else? And that's really what I'm looking for.
Last year in reverse. Just a little bit this morning so far, at least, in foreign exchange as well. 109.67, we had seen 110 on the euro against the dollar. Last year, of course, the first down year for the dollar index since 2020, I believe, TK. The euro negative this morning, seeing a reversal of recent moves, but the Swissy, TK, recently, some really interesting levels out there in G10.
You read my mind. As you know, folks, John and I really don't speak to each other, and particularly in the break. We didn't talk when he slipped in the door here this morning at 5:55. The answer is I triangulated. I looked at dollar Swiss, I looked at euro Swiss, and John, I went back and I looked at trade-weighted Swiss. For those of you on radio and CarPlay, it's real simple. The chart is jaw-dropping the appreciation on a trade-weighted basis of the Swiss franc. And John, this is really beginning to move, and I think for global Wall Street, this is a major story to see the Swiss strength that we've seen.
More on that in just a moment. Under surveillance this morning, your top story, oil rising, inching higher as tensions in the Red Sea escalate. Iran sending a warship in response to the US Navy sinking 3 Houthi boats over the weekend. This as Israel enters its next phase of war. Lisa, pulling 5 brigades out of Gaza in the coming days.
And this really goes to the conversation we were having earlier about the domestic issues in Israel and the fact that the economy is struggling with so many people out of the workforce and fighting. I will say oil, I'm so focused on this year. We were completely surprised at the end of last year of how much prices went down despite this conflict. How much of a risk is this to markets if prices go up? And it really challenges this concept of inflation steadily moving lower.
As an amateur, I am completely focused on the domestic politics of Israel and Mr. Netanyahu. That's what I saw in the zeitgeist over the last 5, 6, 8 days. I think that's underplayed in the U.S. press.
I need to turn to another story, Tom, out of Japan. The latest developments, a Japanese Coast Guard plane colliding with a Japan Airlines flight at Haneda Airport in Tokyo. All 379 passengers and crew on board the larger Airbus 350-900 aircraft evacuated safely, but 5 of the 6 crew on the Coast Guard plane confirmed dead. The smaller plane was carrying aid to northern Japan, where a 7.6 magnitude tremor hit the country. Lisa, at least 48 people have been reported dead.
Did you see the images? Just of these incredible shaking rooms, shocking, and then the surf coming up and houses crushed, cars crushed, and then here's a crash, the cause of which still has not yet been determined, this according to local reports. What's going on? You know, this is sort of yet another sort of tail risk, and you see it as it emerges for that economy. And people don't know how to price this in, but you have to really focus just on the domestic humanitarian issue.
And looking back over the last year, this, you know, what's going on, this just speaks to the risk of earthquakes, which are usually on very predictable fault lines, like the horrific earthquake that was in Turkey, and I'm going to call it southeastern Turkey here, X number of months ago. I mean, it's just, this is with us in our perfect modern lives. No, they're not perfect, they're not modern, they're earthquakes.
That's the latest on Japan. I want to finish on this story. The Biden administration cutting back on incentives for buying electric vehicles. The number of EV models eligible for a U.S. tax credit over $7,000 cut at about half. Lisa, the new list, excluding vehicles that use battery components made by Chinese manufacturers. You're going to hear a lot about this in the months to come.
I was looking at what that includes, which cars, right? So it's the Ford F-150, it's a whole host of others, it's Stellantis, it's a number of them, it's Tesla, one model. It's interesting to see how much this is being done in the guise of trying to reduce any kind of benefit to China versus reducing some of the emphasis on these electric vehicle credits with a kind of shift that you've heard under the cover a little bit from the administration and from auto manufacturers as well.
So if EV sales are struggling, already. Tom, what happens when you lose some of that tax credit as well?
Oh, that to me is the whole thing. What happens when the tax credit goes away? And I think that's something that goes directly into Tesla as well. Let's quickly get to Terry Weissman of Macquarie here on global FX and all the other things that get us back to a great bull market in the United States. Wonderful to have you, Dr. Weissman, to get us started for the year. Let me go to the larger view, which is everything hinges on China. Do you agree?
Not for 2024, no, although I do think that China is a very important part of the macro story globally. We have the central banks in the U.S. to worry about. We have the central banks in Europe to worry about. And we have supply shocks, especially in the natural resource markets and the oil markets to worry about, too. So China is important, but it's not all or nothing as it comes to China. I will say this, though. I think the market is somewhat wrong in focusing too much on the property sector in China and aggregate demand in China. I think what the market has lost sight of to some extent is President Xi's willingness to go after the tech sector in China, and more generally, against the whole concept of private property in China. I think this is what is souring sentiment for China, and I think to the extent that that finds some relief in 2024, right, it could be a bigger deal for China on the upside than some resolution to the problems on the balance sheet of the property sector.
There's been a multi-decade failure of international stocks, and some would correlate that over to an ever stronger dollar. Is the dollar finally broken where there's an unspoken opportunity in international equities?
Well, if you're asking, is the dollar as a reserve currency as the standard for international trade, international finance is over? No, I know. I don't think so. If what you're asking for is there going to be a structural break with regard to the status of the dollar in international capital markets and international trade, I think the answer is no. Remember that we had a period before we had globalization, before 1995 for that matter, when China and Russia and the other emerging markets were not that fully integrated into the global economy or the Washington Consensus for that matter, and yet we still talked about the dollar as the reserve currency of the world. Why? Because a good part of the world still depends on the dollar for its trade and for its commerce and for its financing. So no, I don't think that's going to happen anytime soon, at least.
One of the charades that we do at the beginning of every year is to come up with potential tail risks, which inevitably will probably be wrong. But there is a question here. Tail risk of the dollar being somehow profoundly debased seems to be off the table from what you just said. What about sort of the tail risk of some sort of significant supply shock? You sort of alluded to that initially in the commodity space.
No, that I think is a bigger tail risk. And I think it behooves every investor out there to at least have some oil in one's portfolio, be long oil. Because when you think about U.S. recessions in the post-war period, you'll find an amazingly large number of them had been preceded by a rapid rise in oil prices. You'll see that. And it behooves investors to have some oil in the portfolio because we just don't know. To the extent that we do have a supply shock, oil prices will go up, and you'll offset the losses you would otherwise experience from seeing stocks go down, from seeing bonds go down in that context. So,
well, this raises a question to me of how offsides the market would be should there be some sort of oil supply shock, given the fact that people have kind of gotten accustomed to the idea that the U.S. is producing record amounts, right, and that even in the face of conflict, oil prices went down. How wrongly positioned are people for this kind of event?
I don't know how wrongly positioned they are. There is a case to be made, however, for the logic of oil prices having come down in the last few months. And the logic is very straightforward. The elasticity of supply in oil is actually quite high, and potentially higher than the market surmised before 6 months ago. What we have seen with the increase in oil prices that preceded this decline is a huge increase in oil production in the U.S., and that is the basis for why oil prices are down. But if we were to get a shock out of the Middle East, for example, a shock out of Russia, it's not conceivable that production can go up quickly enough to offset that in a very short period of time. And that's the risk that we face right now from these shocks. Over the long term, there'll be an adjustment in U.S. supply. That's positive and beneficial, but not in the short term.
Is the U.S. dollar a commodity currency now?
No, I don't think so. Certainly the market doesn't see it that way, right? It's interesting. There are some emerging markets that we don't necessarily associate that much from the perspective of their current account balance and their trade with oil, because they're not huge net exporters, Brazil, for example, but they are large producers. And yet the market tends to associate the Brazilian real with oil more than it does associate the US dollar with oil.
Do you expect that to change anytime soon?
No, I don't think so. And that's because no one's going to really associate the US with a very large net export balance in oil. It really has to get to a point where U.S. trade is dominated by oil, and that is not the case yet. It's still dominated by services and technology.
Very true. TK, the number's just absolutely staggering when it comes to production. 13 million barrels a day in this country.
Yeah, what's interesting is we don't have an oil policy. I mean, we take great pride that Washington has never come up with the plan. We've got this plan, that plan, whatever plan. I guess it's a technological success.
Not sure we need one.
No plan.
Well, to that point, do we need one? Is Washington, is the White House irrelevant with regards to this conversation?
Only in respect that oil is such a geopolitical issue. And of course, geopolitics and politics generally have to be managed either through diplomacy or through some management of market forces that are relevant to geopolitics. That's a case. There's a case to be made for the energy market to be managed from that perspective. But if it wasn't for the importance of oil from a geopolitical perspective, I don't think so.
Terry, it's good to see you.
My
Happy
pleasure.
New Year. Thank you, sir. Terry Wiseman there of Macquarie. If you are just joining us, welcome to the program. Your S&P 500 session lows. We're negative here by 0.7% on the S&P 500. I think every time, Lisa, we quote the price action this morning, we've also got to reference the gains of 2023.
Totally.
0.7% against the move of, what, 24% on the S&P last year.
107% for the Magnificent Seven stocks alone in 1 year. And these were the stocks that were supposed to underperform. To me, the shocking thing is, though, with all of those gains, incredible moves, we're basically back to the S&P levels that we were on January 2022. We're basically come full circle. And so now people say, are we just going to sort of middle through, which is essentially even the bull case, or is there going to be some sort of different paradigm this year?
In 2024, I'm going to go back to the habit. You do see this in the earnings reports as well as where are we from Q4 of 2019. And if you look at that, the answer is you got double-digit equity returns, some would say off the Biden stimulus and the rest. But there's a habit here from last year that maybe we have to continue, which is how do we gauge ourselves in earnings, economics from 12/31/19?
How long does it take to get used to 2024, a new year? Do you remember when you were a kid, Tom? You have to write down the new date.
In May and June, I'm writing checks in May and June.
Right? The last 3 years ago.
Exactly.
I feel exactly the same.
Start doing 2025 early.
You want to start now?
I mean, just get practice so that coming to the next year, you know, a little bit more advanced.
Let's go.
Okay.
Here's the price action on the S&P, pulling back by 0.7% on the S&P 500, pulling back a touch more on the NASDAQ. If you're looking for the why, plenty of reasons. Maybe one, Apple, a downgrade from Barclays. The team at Barclays downgrading the stock from equal weight to underweight. The stock is negative 1.85% on Apple in the pre-market, 188.97. From New York City this morning, with equities pulling back as we kick off a brand new trading year from a beautiful New York City, this is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, you know, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
your challenge.
Britain's next.
Was going to keep rain World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Leaders were the big tech-enabled companies. They were safe havens, fortress balance sheets, great cash flow, great places to hide out in economic and political turmoil. We still have a lot of that turmoil, obviously, but you've got the Fed wind at your back in 2024. You've got an economy that has probably hit a soft patch, but I don't think is going off a cliff. So I think that gives some room for a broadening out of the market.
Where is the market leadership coming from in 2024? That's the big question. An answer there from Chris Marangi, the co-CIO of Gabelli Funds. From New York City, welcome to the program. And once again, Happy New Year. Your equity market on the S&P 500, session lows, negative by almost 0.75% on the S&P 500, following a massive year of gains on the S&P, on the NASDAQ as well. Apple, responsible for some of the move at least, is negative by close to 2% in the pre-market, off the back of a downgrade from Barclays this morning, with Tim Long of the team taking a stock down to underweight from equal weight. Tom, we're negative there by 1.9%.
There's some people out there that really agree with this. Frankly, they're looking at this huge dominant unit count of iPhones, which is without question the dominant strategic part of Apple as well. Then there's a service sector ever building, and then there's that they're managing for profit and use of cash. And this is a titanic battle. And maybe this is the one stock where there's the harshest divide between, sure, Doug Cass later on Bloomberg Radio, he is short Apple.
It's a growth stock, Tom, that went ex-growth and still got multiple expansion.
Yeah.
And still delivered gains of close to 50% year-to-date last year.
No, it's there. And, I think this is important, John. The Magnificent 7 or 8, whatever it is, they're all different stories. I don't like that they get bundled together. There's a huge set of different stories there.
Well, as Lisa suggested, when you do bundle that 7 together, that 7 delivered some pretty big gains in 2023.
Yeah, 107%.
It's not bad, is it?
Well, but there was a lot of divergence. I mean, people say there's going to be divergence this year. There was a lot of divergence last year. I mean, NVIDIA was up 240% to the 50% of Apple. Huge divergence.
I'm just thinking of the total return of the triple leveraged all cash fund.
You're just pausing for thought?
Yeah, no, triple leveraged all cash fund can't compete with that. There's no question about it. We digress right now. This is important. We decided that EM in China is so important to year 2024. We took the great Terry Weissman of Macquarie, and we tag teamed him with Damien Sasso, our chief emerging markets credit strategist for Bloomberg Intelligence. The importance this year of EM and this massive mystery of China, I called it out on social, the known unknown that's out there. Let's begin with first principles. Is China an emerging market? Politically, the way we treat with them, they're a developed economy. What are they?
Well, they're considered an emerging market, certainly in my universe in fixed income, right? But I think what Terry was alluding to, and I think the real shift for me in the last few weeks, certainly since the Fed, has been in the factors that are driving foreign exchange returns globally, not just in EM, but in G10. And for me, that means it's a shift from carry, which has been the primary driver of outperformance across all currencies, whatever shape and size, since the pandemic started, to value. And we're starting to see that. We've had 2 consecutive months of negative performance in just about any carry index you see on the FX side, and now we're seeing value come back. So what does that mean for emerging markets like China? It means funding currencies like the China yuan, which has been a funding currency, should start performing pretty well.
Is China's credit rating off of the Moody's news last year, is it at risk right now? Fareed Zakaria in Foreign Affairs led with that idea of the credit rating of China. Are you watching that?
Yeah, the Pledged Supplemental Lending Facility, which is the facility that China used from 2014 to 19 to rebuild their shanty towns, which caused the housing boom, which now President Xi is starting to unwind. They're back in the game with that now. They're basically, I guess it's China's form of quantitative easing, call it what you will, but they are definitely plowing money back into the policy banks, and we're starting to see some evidence of that in the PMI data.
How much pressure can a leader with no term limits be under?
Not that much. I mean, look, I don't know the dynamics about what goes on inside of Beijing, Jonathan. I think very few people can say that with any sort of credibility, but, you know, there's certainly a sense from President Xi that he's trying to repair some of the, I guess, tighter policies that kind of have restricted the economy for the better part of the last 2 years. He's trying to undo that, but it's so difficult to undo sentiment, specifically domestically amongst consumers and households, when it's been damaged so utterly unbelievably. And talk about foreign corners, forget about it. The FDI data just came out a few weeks back. It has been dismal. I mean, just huge losses. Nobody's investing there from abroad, so they're looking inward, and it's just not working out.
Whose confidence is lower, consumers in China or investors looking into China?
I think investors looking into China, certainly.
How do you repair that?
Well, I mean, other than a regime shift, it's going to have to be something more tangible than that, right? And look, I mean, you could say all you want, and we could bash China here till but we could easily bash the Fed. I mean, look at El Arian over the break, you know, and the Fed credibility issues. I mean, I'm going to channel Chair Eccles again and say, my goodness, the communication's been awful on the Fed's part. That's what's kind of driving a lot of this regime shift we're seeing in FX. And look, you know, I mean, the communication's been abysmal in the U.S. as well. So, I mean, for a speculator or a hedger looking forward, it's just difficult to kind of get a gauge on the market.
So let's take the other side. After a whole year where people are talking about China being uninvestable and that foreign investment sentiment being just at the very bottoms, can it only go up from here? I'm hearing more and more people getting bullish on China just because things got to get better than this. And you have, on the margins, Xi Jinping having certain stimulus, maybe not as much as people want, but the latest being $50 billion of low-cost funds to certain policy-driven banks. I mean, on the margins, kind of starting to respond a little bit.
It was the same argument that many investors made in the beginning of last year. Remember when we saw, you know, the CSI, you know, kind of rally. And look, people who rode that up did really, really well. But if you held on to it, you had a loss on the year, right? So it is a very tactical trade. I mean, it doesn't take a lot to move Chinese equities in this market, I don't think. But again, going back to FX, I think that's the real story. The carry trade unwind is real.
Meanwhile, overnight, we got some economic data that wasn't so good out of China, but we also got economic data that wasn't so good from South Korea, from Taiwan, from a whole host of other Asian countries in the region. How much is this a China problem, and how much is this a regional problem? And can you just distinguish those two things?
It's interesting. It's not just a China problem. It's more of a Europe and U.S. problem, right? It's the end demand. It's export orders. If you break into the PMI data and you look at export orders, export new orders, all of those gauges are down within the PMI. I mean, the one little kind of, you know, silver lining we saw was in the construction, and which speaks to all the funding, all the financing that you rightly point out that the PBOC is using to stimulate its economy. But certainly from an export-oriented, I mean, South Korea, Taiwan, you just said it all. I don't think it's China. I think it's more U.S. and Europe and growth and a lot of what we're seeing on that front.
Let's look at the emerging market, Switzerland.
Ooh.
I came in and triangulated dollar Swissy, Euro Swissy, and trade-weighted Swissy. On Bloomberg Radio, we're showing the chart right now in trade-weighted. John, in the middle there is when you and I were in Zurich or Davos, I can't remember where, and we're way beyond this with trade-weighted Swiss strength as well. How disruptive is that to any and all, including EM?
Well, the S&P surprised before break. They were a little bit more dovish than the markets were giving them credit for. I don't know if anybody was watching that, but, you know, the funding G10 currencies of which, you know, Swissy's one of them, Aussie dollar, Stokey's another that come to mind, maybe even CAD. All of them have rallied pretty nicely against the dollar here. Again, speaking to the strength of these funding currencies as the carry trades are slowly unwound in this environment. You know, again, I'm not a big buyer on the fact that you're going to see this massive dislocation between the ECB and the Fed, although that's what the markets is driving a lot of the price action lately. I think European growth is still a real issue, and I think even though they have this mandate on price, I'm not buying it.
Let's go geek here. Greek letters. We need Greek letters. Trading
risk reversal.
Excuse like next to nothing. It's quiet out there. I have massive log convexity on any measurement in Swiss that I see. I've got an accelerated tendency of this carry unwind. What's it mean for our listeners and viewers?
It means that the market's vulnerable to a short-term reversal in what we've just seen. Basically, if you see 1 month, 25 delta risk reversals, which is the skew you're talking about in currencies, they are at or near 3-year lows across more than half of the 30 major currency pairs that we track, not just EM, but G10. So that means that those currency pairs are subject to a near-term reversal where the dollar is going to strengthen relative to them.
5-minute conversation with Damien, and you didn't bring up college football.
I was waiting for you.
I mean,
come on, Alabama.
Huskies.
I was thinking of you.
It's not a classic Nick Saban team, is it?
No, no. I mean, well, look, I mean, J.J. McCarthy, what? I mean, he engineered that fourth-quarter drive, the overtime drive.
A couple of the catches Mr. Wilson made.
I mean, yeah, Mr. Wilson, but then, I mean, the Huskies, man. I mean, who's not going to talk about?
What's the level of underdog of Washington since 1991?
4.5-point underdogs, I believe, is the kind of Vegas line going
Say
into.
It again,
the Huskies are 4.5-point underdogs.
That's all.
Yeah, of course. I mean, Washington's real team.
Your bet, Wolverines?
I think the Wolverines are probably the safe money bet. You know, they're obviously the favorites, but I'm going to be rooting for the Huskies. I mean, I have a fondness going back to 1991 for the Washington Huskies. I mean, you know, I'm just a normal college football fan.
Just a normal
with visions of Pac-10, which no longer exist.
You're done, TK. You're happy with that?
I'm just dazzled.
You don't want to talk about the Red
really
Sox?
Enjoyed, no, well,
Doesn't do
that was
baseball,
amazing.
Shannon.
You see what Mullerian posted about the
on radio
Pats?
yesterday. I mean, like, my God, the God went out. He went to the Braves. What's that about?
I don't know. I mean, look, the Dodgers are going to own baseball this year. It's really sad. They have everybody.
Yeah, but it's so certain.
They got someone else, didn't they?
Yeah, they got the pitcher.
He's got $1 billion. I mean,
It's the time.
But they don't have to pay it until 2050, so don't even worry about
Yeah,
it.
that they have all the, they have all of
course,
the,
yeah.
they have all the luck because people want to go there because it's LA Times. So they
Taxes.
Yeah, there's a lot of.
That helps too.
that really, yeah, that's good.
No,
Damien,
there's a
thank
whole
you.
conspiracy
Good to
theory.
see you. Damien Sasta.
Salah missed
Happy New
that
Year.
penalty shot at Liverpool.
Then scored
what was
one
that
later.
about?
Then scored one later.
Yeah.
Yeah. That's just sports chat.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Do you think there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think the bullishness is probably has a wider window to perform in going into 2024.
I think we're going to feel a little bit pressure on the big caps coming into the new year.
I don't expect to see the Magnificent Seven crater in 2024.
There's a lot going on that we think is very positive.
and that the market is starting to sniff out, and that makes us constructive not only through year end, but into 2024.
The market, Brett, will continue to widen out, but we do think that some of the leaders from this year will continue to be leaders for next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Good morning to all of you. Good morning, 2024. In moments, we're going to talk to one of the great bulls of Wall Street. John Stolfus is going to join us from OPCO. And John, what this is about is putting economics into stocks, and that begins with a busy economic week on the labor front and what it means for this bull market.
We are absolutely hitting the ground running for 2024. We have payrolls on Friday, the following Friday, kicking off earnings season unofficially with JP Morgan results, Tom, just around the corner after some massive gains, 24% on the S&P, more than 50% on the NASDAQ 100. Can we get some broader gains this year, Tom? Does the leadership start to change?
It's about nominal GDP. I think Michael Darda are very much focused on the animal spirit of the country and all the mystery of that. And one theme, as we heard from Bruce Kasman, JP Morgan, is, yeah, we get the good feeling, but the then what? I don't know where the then what is. Is it in May or is it in August?
There's some big lessons to learn, Tom, from the last year or so. It's not just about eating humble pie over Christmas and saying that the economists got it wrong and the equity strategists got it wrong. It's about trying to learn which data points are relevant and which data points are totally irrelevant. And when you look back at the last year or so, the ISM manufacturing has been sub 50 in contraction territory, Tom, since late 2022 and the whole of 2023. That data point, if you focused on that, it would have taken you down the wrong path for the US economy. Tom, if you'd focused on something simple like jobless claims, that would have told you week after week, every single week, that things were okay in the US economy.
ISM tomorrow, and this is the important, there's two sets of ISM, right? And tomorrow we see ISM manufacturing and all the subparts as well. That's at first look that you look at, right, John?
Yeah, and then on to services, TK, then on to jobless claims. At least I think we get JOLTS later this week as well, don't we?
We get that, yeah, tomorrow we get that at 10 a.m. I'm curious to see how this all feeds into whether the U.S. can continue to fuel some double-digit gains in the stock market. We talk about the biggest bulls taking all of this mush and coming together with projections. The biggest bull is predicting a 9% gain on the S&P this year. That is not that much after last year's 24% gain. The year before it was a 20% loss. The year before it was a 27% gain. There has not been a single-digit kind of gain or loss since 2018.
But then CFA 101 is maybe you take it harmonically, which is if you got a 24% number in the rearview mirror, then you go to 12% the next year, then 6%, then 3%. You bring it on down. I guess there's a lesser anticipation here. But I'm sorry, there's just too many mysteries. I'm going to the Farrow rule, Lisa, which is the year begins March 31. I got to recalibrate somewhere out there.
First quarter. No, we always start programs like this, Lisa, every single year, and we talk about consensus. And I think you're right to point out where the highest forecast is right now. The low is 4,200. The high is 5,200. That is a 1,000-point spread. Lisa, I think any conversation about consensus is totally misleading because when you go through all of the forecasts, the range is so wide for the equity market for the year ahead.
There aren't that many people, though, talking about the same kind of tail risks as they were at the beginning of 2023, a catastrophic kind of recession, something terrible. No one is expecting that. There is sort of this feeling that we've dodged that bullet and there's going to be maybe a soft landing, maybe it's a harder landing, but nothing that's going to really shake the boat in any kind of massive way. To me, that's the interesting thing. To the upside or the downside, where is that shock factor?
To begin the data, John, the Bloomberg Financial Conditions Index, Goldman Sachs has a good measurement as well. 11 ratios, I believe it is. And it has shocked me as this bull market of how accommodative we are. And we curve up and we're really getting out to some substantial societal and economic accommodation, which Chairman Powell has to deal with.
Just a tiny bit more restrictive this morning, though. Just to go through some of the price action on the morning, on the session so far. Equities pulling back on the S&P. We're down by 0.8%. Yields are a little bit higher. The dollar is a little bit stronger. Crude is running as well. If you want a single name, it is Apple. Apple in the pre-market is down close to 2%, which doesn't sound like a big move, but it's a major weighting on things like the NASDAQ 100 and on the S&P. The number one weighting, we're down by about 2.2% currently in the pre-market. Tom, following a downgrade from Barclays and the team a little bit earlier this morning.
What is interesting here in the game is to look back at people that got it right. Yes, we look at the people that got it wrong always with great humility. But now John Stolfus joins, Chief Investment Strategist at APCO Oppenheimer Asset Management, and we speak to him about the bull market he nailed last year and continues to nail this year. John, I'm going to take it back to the analog of the middle 70s, a horrific recession, the leap in 1975, and then a follow-on in 1977. Is 2024 a follow-on bull market?
I think in many ways it is, Tom. I think the question here really is, or rather the difference is, it's a substantially different background in terms of a digitalized global society for business and the consumer, and what was back then, which was essentially an analog world. And I think things get digested much quicker. I think that the data is of better quality. And because we've been in crisis, in and out of crisis since 2008, all the players, as well as the traders, as well as the investors, are more experienced with dealing with volatility.
John, I think what's so important here is only Stolfus is talking about last year was a prelude. I just think that's so important.
5,200 price target. Year end this year. John, let's build on that. You and I have talked about this a few times in the last few months, and I've appreciated it. Can we just address it right now? How dependent that call is on interest rate cuts from the Federal Reserve?
Not much, really. We're not of the camp that's looking for 6 cuts this year in 2024. We're looking for perhaps 1 or 2. And we're not looking for the first half for cuts. We think it'll happen in the second half of the year and likely later rather than earlier in the second half. To us, the Fed has been remarkably sensitive in practicing its mandate, for a stable economy and full employment as described by unemployment between 3% and 4%. And we think it wants to keep it that way. And so that's what we're looking at. We're a little bit different. We like the Fed, ironically. Very few people do. We think the Fed has done, it shows the Ben Bernanke legacy carried on through Jerome Powell in the sense of communication and clarity.
So it might not necessarily, the rally might not be dependent on Jay Powell, but how much is it dependent on the central bank of Tim Cook?
I would have to say perhaps, I'll keep it away from company specific here, but I would say certainly a business, the consumer, and the jobs market will play an important role this year. Key word to watch for is resilience. When we look at economic data, what we're looking at is for things to show resilience, and what naturally is a challenging environment when you're making transitions, when you have the levels of trouble around the world. The geopolitical risk just seems to keep ramping up by the day. But consider where business plays out in this, where the opportunities are, both the cyclical point where we are on the calendar, as well as the secular trends that are driving potential growth for all 11 sectors.
Okay, so in other words, does tech still lead? I mean, I guess that's the question at a time where that accounted for 15% of the 24% gain of the S&P last year.
Lisa, I think tech certainly remains a major participant in this, but I think what we need to watch, well, of course, communication services, which is about 50% tech related. You also have, when you look at the other sectors, just think about industrials and all the technology in that. And it's a good customer of technology, whether it's sensors or robotics or what have you. And the cloud, big data, and all that AI. So when we look at this, whether it's a utility company, whether it's a materials company, whether it's a pharmaceutical or a biotech, technology is where it's at. Right. So we can't but think. The other reason is last year tech was fabulous in its performance because it had been so brutalized in 2022 when the bears sold all of tech. The long duration they sold because they were worried about refinancings, but they sold the good stuff that was highly profitable, positive cash flow, great products, and deeply embedded in the lives of business and the consumer.
John, the cliche is the boat has left the dock. I would guess a very large percent of the surveillance audience feels like they missed 2023. How do you get back in the game if the boat's left the dock?
Yeah, Tom, I would say for the people who missed this, I would say it's a question of layering in. It's not back up the truck at these levels. Consider opportunities that show up when you get some weakness in names that may have gotten away from you. Look for babies that get thrown out with the bathwater in downdrafts to add to positions that you're building. And in essence, what you want to avoid is just blindly buying dips. You want to be selective, even within what appears to be a nicely broadening rally after, as Lisa pointed out earlier, I mean, we're still back to the future in terms of the prices of stocks in many cases outside the Magnificent Seven. And even they're they've got, it would look like they've got plenty of headroom available to move higher.
In so many ways, we had a decade in a year, as Lisa and I discussed a little bit earlier on the program. John, wonderful to catch up with you, sir. Happy New Year. John Stolfus there of Oppenheimer Asset Management. Year-end price target 5,200 on the S&P. He was bullish on the S&P last year. He was right to be. TK, when you get into the details of the call, though, not that dependent on rate cuts from this Federal Reserve. When you speak to John, that's not the big haul here.
He's got underlying 11% earnings growth, and the question is, as Lisa mentioned at the very top of the show, the multiple expansion question is just front and center. I got it wrong. Everybody else got it wrong. There it is. Now what for this multiple expanded part of the market?
5,200, though, and I just keep reiterating that, is 9% above where we closed.
Single digit.
Right, from the previous, at the end of the year. So at this point, that's the biggest bullish call. It's not necessarily calling for another massive returns year in the overall index, but what it's calling for is a muddle through with these secular shifts in technology in other areas.
Quickly here, this is critical because in CFA 101, 9% is a great year. We forget that, but 9% actuarially is a plus year.
It's a rolling call for 10% upside, Bramo. You get the 10% upside, then you come out again and you call for another 10%. It's not that easy, obviously. If you are just joining us, welcome to the program. Your S&P 500 session lows, negative here by 0.8%. Responsible for some of the move. This move in Apple in the pre-market. Apple lower off the back of a downgrade from Barclays and Tim Long from equal weight to underweight. Their stock is down by 2.3%. As we've mentioned repeatedly, though, through this morning, you can't quote that stock without quoting what we did over the last 12 months. Just go through some select names in tech over the last 12 months. Apple up 48%. Amazon up almost 81%. Who was talking about that? Hardly anyone talked about a stealthy 81% rally, Lisa, in Amazon over the year. Alphabet up 58, Meta up 194.
Yeah, although not all of these stocks are the same story, right? We've been talking about that extensively. Amazon, as well as Microsoft, with shares up 57%. That's stemming from some of the cloud computing, some of the generative AI, some of these other things. With Meta, it's the advertising that came back in bulk. With Tesla, it's its own sort of situation. But then with Apple, there is a question of people are not upgrading at the same level. People are not buying new iPhones. Yes, you do have people still shelling out thousands of dollars for their whole progeny and everything in their household. But at the same time, it's not increasing that much because people are running out of cash.
Took you a few hours to make this personal.
I'm just warming up. 2024.
It takes a couple of days here, beginning of the year, to get to the Bramo gloom. You know, we've got to.
Is that gloom?
It takes a couple of days.
Mandeep Singh of Bloomberg Intelligence joining us on Apple and a downgrade from Barclays. The latest on Big Tech with Mandeep in just a moment from New York City. This is Bloomberg.
noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. The jobs report last month beat estimates.
That is a stunning number.
That is what nobody was expecting.
The bullish train has left the station.
This is what Powell does not want to see.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
You're really not seeing the level of restrictiveness show up yet in the labor market.
Significant job growth and high labor force participation.
There's a very strong chance that the market is mispriced for 2024.
The December jobs report, Friday on Bloomberg Television and Radio.
Leaders were the big tech-enabled companies. They were safe havens, fortress balance sheets, great cash flow, great places to hide out in economic and political turmoil. We still have a lot of that turmoil, obviously, but you've got the Fed wind at your back in 2024. You've got an economy that has probably hit a soft patch, but I don't think is going off a cliff. So I think that gives some room for a broadening out of the market.
Massive gains in 2023. Can we get more of the same in 2024? That was Chris Morangi, the co-CIO of Gabelli Funds. Here's the price action this morning to kick off a brand new trading year. Your equity market lower by almost 0.9% on the S&P 500. Futures on the NASDAQ 100 a whole lot lower, negative by more than 1% in the last hour. Off the back of this move on Apple, let's talk about it. Apple in the pre-market looks a little something like this. We're negative 2.4%, near session lows. Off the back of this call from the team over at Barclays, they lower their price target only a touch, from 161 to 160, still using a PE multiple of 25 times their full year 24 EPS estimate. But here's the quote, and I think the quote speaks to the general angst, the nervousness people have around this name. More generally, after a big gain of almost 50% for the year 23, we downgrade our rating from equal weight to underweight as we believe the continued period of weak results, coupled with multiple expansion, is not sustainable. We also believe 2024, Tom, will bring more services risk to light. Now, that was a question we've been asking through the whole of 2023, but the stock kept rallying, and I guess the question we'll start 2024 with as well.
I'm going to go to technical analysis where you see support, and the answer is you see support in the NASDAQ 100. We're there right now. We've barely pulled back even with today's angst. And on Apple, maybe it's a little bit grimmer chart, sitting on support. It's been there since early November as well. We're so short-termism, John. We're just down to, oh, it's Tuesday morning. We've pulled back. Quick headlines, and
so
I
let's
just
talk
don't
about
buy it.
The last 12 months.
Yeah.
iPhone went ex-growth, which is why a lot of bears were bearish. The bulls were bullish because, Tom, if you look at the revenue mix towards services, higher margin businesses, that ultimately this can pick up, and you get the cash machine continue to spit out cash, big capital returns program, and you get gains like the gain we got last year. That's the bull and bear thesis right now into 24.
And it is about technology, which is everybody's focus, those that have been in it and those that have missed it. And John, to have Anurag Rana with us at Bloomberg Intelligence, Mandeep Singh, and everyone else that we have is a huge advantage that we lead with.
Mandeep Singh joins us right now from Bloomberg Intelligence. Mandeep, good morning and Happy New Year.
Happy New Year.
What did you make of that call from Barclays on Apple this morning?
Well, so last year what we saw was among the big tech, there were companies that had clear exposure to Gen AI on the cloud side, namely Microsoft, Amazon to an extent, and Google. Google has both ads and cloud. Apple was the one company where everyone kept doubting their product refresh cycle, and rightfully so. And till now, you don't get that conviction that, a large language model can run on a phone. Right now, large language models are running on data centers. We are going through a massive refresh cycle, and cloud companies are the major beneficiaries of that. We still don't know when that will happen, but we know it will happen. It's a matter of time. The large language models, the technology, the co-pilots will run on your phones. And right now, there is no alternative device except for your Apple ecosystem, whether it's your phones or your PCs.
Just for AI specifically, do you suspect the winners of 2023 will be the ultimate winners? Any reason to believe that's not the case?
Well, we are so early in this cycle that, these are multi-year trends, and we know from the past year action that this is something that has a long runway. You're upgrading all your data centers. I mean, you will upgrade all your devices as well. Right now, you are in the process of upgrading all your data centers. Yes, the growth rates were stellar last year. There will be tougher comparisons. There will be a digestion phase, but the fact is this is a multi-year cycle, and that is not going away.
You do the most hardcore research on this that I've seen, and you published in the last days a terrific piece on the reality of AI. There's a satire group out on Twitter, Adweek, W-E-A-K, Adweek. It's phenomenal, folks. And they talk about in search after AI of the next bright, shiny object. Your bright, shiny object is $1.3 trillion in the next 9 years in AI. What part of AI is real, and what part of AI is the spoof of what we see from Adweek?
Yeah, so look, I think the data center part is real. Training of algorithms, models, this is real. Your data centers, your devices are going to get upgraded. Your ads are going to be more targeted. Whether you like it or not, these companies have more data. And that's where, there will be disruption. Software as we know it is not going to be used the same way.
You and Anurag run it together. How do you respond to, Lisa, am I right, the hysteria that's out there about AI? Everything is AI. Every ad agency's doing it. AI, EIO. How do you respond to the hype of AI?
Well, the hype is there are certain cases, especially on the healthcare side, you may not have the best data to make that 99.99% call when it comes to giving someone advice, and you can't take a chance. We've seen that with autonomous driving. There are real challenges, and that's what companies are trying to solve for. You can't take risks with someone's life. So in the end, it comes down to the accuracy and the use case involved. And for most of the customer service use cases, a 99% accuracy is good enough because it gives you efficiency. Think of coding. I mean, we need a lot of coders around. If AI can help you expedite the way you code, that's a big productivity improvement. So those are the kind of gains you're going to see more of this year, and then we'll strive for the 99.99% use case.
Which is something that we'll parse throughout the year, the details of exactly some of these use cases, which I find fascinating. I'm just focused on the fact that this morning we're seeing in that 2.4% drop, a $72 billion market value erasure from the S&P 500, from Apple. I'm just wondering what this tells you. You're seeing such huge swings on speculation in these behemoths. What that signifies to you of where appetite is and how much skittishness there is on the part of investors.
Yeah, look, I mean, valuations have expanded, and it was primarily driven by multiple expansion, except for the likes of NVIDIA, which grew into the multiple. Everybody else, it's more of hope that AI is going to generate incremental revenue. In the case of Microsoft, they've told us cloud is about 2 to 3% of their Azure bucket. In Apple's case, we don't know anything when that incremental revenue is going to come from. They don't have a cloud business, so it has to be a refresh-driven kind of incremental revenue.
This is really important. Are you saying that without some sort of artificial intelligence overlay or some other new innovation at Apple, currently the multiple doesn't make sense?
Well, it is at the high end of the historical range. And you go back in time, last 10 years, this is the highest multiple that Apple has ever traded at, even though it's much bigger in scale than it used to be 3-5 years back. So clearly there's a lot of hope and optimism baked into the multiple, but we know they have the distribution. They own the install base, and that's where Gen AI will be deployed. So there is a good reason to be optimistic.
Apple is the odd one out, I would suggest, the head scratcher. Wouldn't you say, of 2023, of the 7?
Yeah, because they haven't given us that incremental revenue bucket. That cloud bucket is what is missing in the case of Apple. You see that with Microsoft, Amazon, Google. You don't see that. And we know Gen AI is expensive. It's going to cost a lot to invest even for these companies. Maybe it needs to make an acquisition. to drive that.
And yet the stock still rallied close to 50%. We could talk about what that acquisition might be at a future date. Mandeep, thank you. Mandeep Singh there of Bloomberg Intelligence on Apple. Near session lows down by about 2.5%. The Nasdaq 100 down by about 1.2. The broader equity market on the S&P 500 shaping up as follows. Equity futures pulling back near session lows on the S&P, negative by 0.8% on the S&P. Yields a little higher, up 9 basis points. The dollar a little stronger against the euro, 109.57. That currency pair down 0.8%. And crude rallying 73.30, up by 2.3%. In the next hour on Bloomberg TV on the Open, Jim Bianco of Bianco Research, Samir Samana of Wells Fargo, and Amy Wu Silverman of RBC Capital Markets. Lisa, to talk about the data for the week to come, the earnings that come next week from JP Morgan and the big banks, and the conversation no doubt will end up on rate cuts to be or not to be anytime soon.
You sound so excited. Honestly, this is going to be a really interesting week. We're going to get some real key data points to hit the ground running as we start off 2020. We're still 2024?
2024.
We're not 2025 yet, right?
Yeah, 2024. We'll be talking about 25 before you know it. Right? In a heartbeat.
Maybe.
Equities negative from New York City. Good morning.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
get 2024 started on a Tuesday, a busy economic week. We'll talk about that in a moment. A market check for you with some challenges out there. Futures at negative 0.48% down on SPX. And the 8 seen in the VIX out more than a stick, 14.11. Go to cash, Lisa, 1.66.
To me, what it shows right now, what you can see is sort of this question around what are the most overcrowded trades heading into a new year. And maybe that's what we're learning, as somebody pointed out, one viewer, thank you, because it does really highlight that people seem to be really positioned for a soft landing and a continuation of what we saw last year.
And it's got to be a reset here after all the positioning into a crazy, illiquid vacation kind of a week. I know you were day trading on the ski slopes, and the answer is the bottom line, we're back and we're repositioning, and it's a reset very much correlated across equities, bonds, currencies, and commodities. I want to mention oil. Brent crude 78.53, up $1.50.
I will just point out, in terms of positioning heading into this year, no, I was not day trading from the ski slopes. I will just say that a Bank of America survey that was conducted in December found that fund managers were more optimistic than in any other month since January 2022. And they're talking about being the most bullish on stocks since February 2022.
Well, the economics matters. I like what Tony Dwyer published this morning with Canaccord Genuity. He said investors are giddy. I don't know if Jerome Powell's giddy, but Tony Dwyer's giddy.
Well, maybe there'll be some soberness to the giddiness when we get some economic data. The first week of the new year, we'll have a slew of it. We kick things off today with the S&P Global Manufacturing PMI, followed by JOLTS and Fed minutes tomorrow. Thursday, we get jobless claims and the ADP report, which no one cares about until they do. And on Friday, the December payrolls report. Key in there, really a question around wages and whether a 4% year-over-year gain in wages is commensurate or consistent, I should say, with this idea of the Federal Reserve cutting rates by 6 times in 2024. Joining us is Michael McKee, Bloomberg International Economics and Policy Correspondent, kicking off the year. Mike, how much are people looking for a sense of this data being the important ones to really focus on?
Well, the inflation data that we get later in the month is going to be the important thing because, of course, the Fed is tying everything to the PCE numbers, and the CPI is the sort of warm-up act for that, and everybody's going to be looking at the 6-month average rather than the year-over-year because we've been making progress there. But the jobs numbers are going to be important because of this whole argument that you can't have declining inflation without rising unemployment because demand has to be destroyed. And there is a forecast for 3.8%, a tick higher unemployment. So that's something to keep an eye on Friday. And then the total job creation. The idea is that we need to slow down or we won't see the kind of soft landing that we're looking for. Right. So far, that hasn't worked as a theory. We'll see this week.
Are we still in the throes of the pandemic? I mean, I find it fascinating.
This is weird.
We actually moved on?
We have moved on, and we are starting to see a normalization of the economic data, while at the same time, health experts are telling us that the pandemic is raging, that there are more cases of COVID out there than there have been in months and months and months. It's just that with the vaccination levels, I guess, and whatever natural immunity people have gotten, it's not the crisis that it was. Right. But that doesn't mean it can't come back because this COVID virus keeps mutating.
You put me in the McKee timeout chair once years ago. You said, Tom, JOLTS matters. Does JOLTS matter tomorrow?
Matters less than it had been. It's still a question of how many job openings there are and whether they're still declining. Chris Waller on the Fed he was right. He said we can bring down inflation with a softer labor market by absorbing the vacancies rather than creating more with unemployment. And that's what's happened so far. So if that continues, it'll give people a better feeling about the Fed.
I want to finish up with a real question for 2024, which is the vibe session that everyone was talking about, which is, if you look at the economic data, it looks pretty good. You talk to people, they feel terrible. Do you have any sense of what explains that? Because I've read so many economic reports trying to explain this mystery, and everyone seems to disagree.
Well, there are a lot of different reasons why people think this may be happening. One of them that gets a lot of credence is that it's recency bias. People are not looking at the change in the magnitude of inflation. They're looking at the price level that we reached, and they look at food prices, and they look at house prices, and they think that inflation is still out there. Gasoline's telling them something different. We're starting to see a little change in consumer sentiment. So maybe the vibe session, to the extent there is one, will start to change. Joe Biden, I know, is certainly hoping for that. And the good news is that maybe, according to the weather people, we might get some snow this weekend. And
really? I did not
those
know
who
that.
are going to go day trade from the ski slopes will
probably.
actually have some snow.
Some of us might have already looked at that weather forecast.
to-
Let's move on.
Let's move on. Michael McKee's going to move on to 3 very busy days of economics here for Bloomberg Surveillance. This is a joy. Aditya Bhave joins us right now, senior U.S. economist at Bank of America Securities with Parchment from Chicago. And one of the great things he does is focus on the American consumer. That's 70% of the American economy, give or take a percentage point. It's a 70% solution for every economic analysis. And it's a good place to start 2024. What is the strength of the American consumer?
So we think the American consumer looks good. That's the bottom line. I think if you start with the foundation of an unemployment rate less than 4% and wage inflation more than 4%, that is a great starting point for the U.S. consumer. You look at spending through the holidays, November retail sales look solid. Our card data through the second week of December look pretty good. And then you look at travel, right? I think travel is a great indicator of how the consumer is doing. It's discretionary, and then it leads to more discretionary spending. When you fly, you go to restaurants, you spend money at hotels, entertainment, and so on. And the TSA's travel data look great for the holidays.
I'm lost. It's a 70% solution for the politics of America to the presidential election. Bankruptcies have surged. There's all sorts of credit card. Lisa, you're better at this than me. The credit card gloom out there is tangible. There's all this worry and angst. How do you process that versus the optimism you just stated?
Right, so credit card delinquencies are a point of concern. It's something that we're watching quite carefully. We're watching student loans. These look like modest to moderate shocks to consumer spending, but if you look at our card data, one of the things you can do is you can slice it in ways that you can't do with the official data. You look at the cut by income, you see that lower income households are actually spending at a faster rate year over year than higher income households. So that has remained the case for several months, and that keeps us quite optimistic.
Is all of this optimism and all of this strength and resilience consistent with inflation getting back down to 2%, with the Fed cutting rates 6 times this year?
I think that's part of the story. Real income growth has been much stronger over the last few months because of the slowdown in inflation. And yes, the vibe session is certainly a concern, but people keep spending. So it is one of those things. I think the answer around price levels, sticker shock, is certainly part of the story. But the point is that folks keep spending, and it's pretty broad. The pickup in durable goods was really impressive last year. We'll see if it continues. So it's not just revenge spending from COVID, it's broad-based consumer spending.
This raises this question, and actually Andrew Hollenhorst of Citigroup just published and talked about how this is going to be a more difficult 2024 for the Federal Reserve than many people are giving credence to, especially given the fact that housing prices, which had been challenged, the housing market seems to be the housing recovery now. We're seeing that in building sentiment, even home prices. We're seeing wages, as you mentioned, go up. Is this consistent with inflation continuing to come down without some consistent restrictive policy from the Fed?
Right, so that's the question, right? The Fed has declared victory rather early. It was a remarkable performance by Fed Chair Powell at the December press conference. It wasn't just that the data are moving in the right direction, it was also that the reaction function of the Fed seems to have moved, certainly more than the ECB's, a little bit less cautious. And now the question is, you get all this easing of financial conditions as a result of a more dovish Fed, and will that preempt the slowdown in inflation? So certainly supply expansion has helped, supply recovery, if you will, and that's brought inflation down. By definition, that doesn't hurt output, but the question is now, how much demand destruction do you need to actually get all the way back to 2%?
What is service disinflation doing? I mean, the consumer is paying a lot for service inflation right now versus goods inflation, but is there a legitimate service disinflation?
Oh, for sure. So core services ex housing was running at around 5% early last year. Now it's at 3.5% year over year. You look at the 6-month rate, it's actually well below 3%. So this is something that Chair Powell noted.
What are we waiting for?
That's exactly why we have the Fed cutting
I
4
got to make
times
some
next
news
year.
here. Rate cut, was it January 15th?
Stop.
Rate cut? Come on.
We have 4 cuts
David's
next
not
year
watching.
starting in
Come on.
March.
You know, starting in March.
Yes, starting in March.
There you go.
Well, can we just finish up with the vibe session?
Sure.
Because I really have been spending a lot of time trying to understand this.
Yep.
Because you can't discount what people are feeling. If people are feeling bad, there usually is a reason for it. But as you pointed, there is some inconsistency with how people are spending and behaving versus the sentiment surveys that have come in dismally time and time again. What's your theory for this?
So I think it's sticker shock. Here's a fun fact for you. The University of Michigan index is still below April 2020 levels. It has not recovered since it collapsed with the surge in inflation. I think it's just that folks are seeing prices when they go to the grocery store, when they go shopping, that they're just not used to seeing. And yes, they have the spending power, but it's still unsettling. And it's going to take a while for folks to get used to these higher price levels because the Fed isn't trying to get prices back, right? It's just trying to get inflation back to 2%. So we're probably stuck with higher prices in the long term.
And there have been a number of studies I know that show that people care more about the prices they pay than how much their incomes are going up, and that it matters more, the sticker shock. How long do people have to wait before something becomes normalized? Is there a historical analog?
It's a tough one. Really, the last wave of inflation that we had that's similar to this is in the 70s and 80s, and that's just one data point. And the UMich survey doesn't go back before that. So it's going to take a while, but I think we're slowly inching back towards normal.
Why do we have to wait to March for a first increase? I don't get this. I just, let's get going. I mean, one little rate cut in January is going to upset the apple cart?
Well, no, but I think it's a signal of more to come, right? If they cut in January, the markets are they're already pricing 6. They're probably going to price 7 or 8 next year.
Thank you so much. It's been wonderful. Aditya Bhave with us with Bank of America here, particularly on the American consumer. Right now we're consuming data here in the Bloomberg Terminal Futures, negative 38, Dow Futures negative 215. And I wait to the tape. Apple, are you going to tell me this? Apple, are you going to tell me Lisa's the reason for this? Lisa, are you going to tell me Apple's the only reason? I don't buy it. I buy it's beginning of the year and people are resetting.
I'll give you this name as well. Rivian plunging this morning, down more than 8% in early trading after come out with deliveries that were below expectations, saying they delivered 13,972 vehicles versus an estimate of north of 14,000. And you can see the move now has been retraced a bit to 4.4%, but Tesla came in a little bit with a beat. These are some of the tea leaves, but the big moves are telling you kind of where some of the maybe, I don't know, crowded trades might be.
Well, the Tesla's there, and I don't know if it's part of the Magnificent 7 or Magnificent 8, but it's always in the news, and frankly, it's about EV as well. On the markets right now, negative 37 on the Standard & Poor's 500, and we are down 0.7%.
I'm looking through these numbers, and it really is interesting to see that even Tesla came in below expectations for the 3Y deliveries. So this coming at a time where there's a lot of skepticism around how long some of the buying trends can continue. We have seen Ford pull back from some of their projections of electric vehicle adoption. We see now the fact that subsidies are not going to be as great from the U.S. government for a number of different models that use certain parts that are derived in part from China. So there are real questions here. How sustainable is it?
Stock action here in the boom of the end of the year. Tesla 200 up to 260. I'm going to call it. Comes down to 250 something, and we're off a little bit here. 248 right now is the pre-market here on Tesla.
Yeah, pretty much flat. I mean, honestly, how much can we really read into an entire year for the first day? We're going to try, but it's really a fool's errand. At this point, I think we're setting up, though, with a series of assumptions that we're going to get some sort of gradual muddle-through economy. And that's going to be the real question behind a lot of these idiosyncratic stories. Do we get that, or is it going to look a bit different with a bit hotter inflation and a bit hotter consumer?
Certainly the zeitgeist at the end of the year was a study of EV worldwide, of China, and how China redounds over to all the restrictions of importing into the U.S. versus some real import penetration in Europe as well. Coming up, this is the interview of the day on technical analysis. Urian Timmer, Global Macro Director, Fidelity, Boston. Good morning.
Warren Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things we have this great connection about the love for baseball, and the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I'll go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money, and number 2, don't forget rule number 1.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg.
I think the economy is in a healthy position here. I think it will take higher rates to be sustained here to continue to bring inflation down. Inflation is not going to stay high as it was over the last 2 years, but I think getting down from 3 to 2 is probably going to take more work, and I think it's not going to happen quickly. And as a result of that, I do think the Fed is probably going to be disappointing here relative to the speed at which rate cuts are priced into the market.
That was Bruce Kasman, chief economist and head of global economic research at J.P. Morgan, as we look at a new year, a new trading week, a new trading day with a bit of softness as we parse through just a touch of weakness, but really at session lows, or a little off session lows now, 0.8% decline on the S&P. A bit of dollar strength, a bit of a reversal in some ways of what we saw over the last 3 months of last year, including a lift to crude on the heels of Iranian ships entering the Red Sea in response to some of the attacks from the Houthi militants and then the reprisal from the United States. Tom Keene, Lisa Bromwich, Sean Farrow off to the 9 a.m. hour, but I really think it's going to be an interesting week to set up the year, Tom, to understand what the consensus is and how much it can go wrong.
I think we've underplayed it here with all the equity chit-chat and the answers. It's an exceptionally interesting week, as just framed by the gentleman from Bank of America. And the answer is we get the labor data and within it the wage dynamic, and that's the key determinant to keep the bull tone going. It is about economics at the end of the day.
Just want to run through some specific stocks to continue the stock chit chat. As you mentioned, Apple shares very much getting our attention as Barclays becomes bearish, or at least marginally so on the edges, down 2.2%. But again, that's like a $65 to $70 billion market cap move. You're also seeing Rivian lower by 4.5% after disappointing with their deliveries south of 14,000 vehicles versus the estimate of more than that, and Tesla basically flat. To me, again, I think it's notable that Apple has moved so much, Tom, in response to not that significant of a proclamation, just basically a recognition of reality.
Yeah, well, that's the opinion of one house, Barclays here, that Apple's going to be a little bit tepid, but I think also it's just a normal beginning of the year reset. Everybody's back. Everybody will be back over the next week into the uncertainty of Wednesday, Thursday, Friday, and on this Tuesday, it's a reset, which is beyond healthy. We're allowed to go down every once in a while.
Well, there's this real key question, which is too much good news being priced into this market? Jürgen Timmer asked this question in his recent note, Director of Global Macro at Fidelity Investments. I'm going to ask you that, especially at a time where it seems like people are maybe questioning that bullishness the end of the year.
Well, so I think the bond market's move and the market's interpretation of what the Fed is going to do is a little extreme, right? So if 3 is the new 2 in terms of inflation, which is my view, that it's going to be hard to get inflation and core inflation below 3. And the market, the SOFR curve is saying Fed's going to go all the way down to 3. That doesn't really make sense in a soft landing, right? Because that would be a 0 real rate if inflation's 3 and the Fed's at 3, and at a time when the economy is actually doing okay. So I think the bond market's a little bit over its skis. I think for the 10-year yield, 4 to 5 is a reasonable range, or below 4 doesn't really make a lot of sense to me. So my sense is I'm bullish on equities. I think we're going to have a bullish broadening, but certainly kind of sober January, if you will. We might have a little bit more of a sober tone. And remember, market goes up 2/3 of the time, which means it goes down 1/3 of the time. And so maybe we kind of come to reality a little bit here.
Let me begin with an open question. Your charts are the powerful use of overlay. 1 idea, 2 ideas, a 3rd idea, all on top of the Euclidean surface. Which is a single chart right now that matters for people who want to find the courage to get in Will Danoff's contrafund?
Weekly chart of SPW, which is the equal-weighted S&P 500 index, on a log scale, of course. If you take a weekly chart, you will see a stair-step function.
Are we at 1 standard deviation above long-term trend?
No, we are below the long-term trend. If you go back 150 years, we are slightly above the long-term trend. But if you look at SPW, we've been in a holding pattern for 2 years. Market generally goes up 10% per year, 2/3 of the time. And to be going sideways for 2 years is a long, long time. And so, and of course, as we know, it's been the Magnificent Seven, so many, many other stocks have not participated, which is a great second chance for investors to actually participate if they've missed this. So that, I think, would be my primary chart. If you look at it a slightly different way, S&P 500, cap-weighted index, we are a little bit above that long-term uptrend. Obviously, a lot of very benign soft landing dynamics being priced in. I don't think the Fed is going to deliver what the market is expecting. The market's like a spoiled child. The Fed gives it 3 rate cuts. The market wants 6, never happy. So I do think one of the stories for 2024 will be the Fed walking back some of this very dovish narrative.
There could be a situation where, yes, you do see a broadening out in some of these sideways moving stocks over the past 2 years, outperforming. Does that even matter, though, for the overall index if you have the golden children of the whole past cycle, which is the Magnificent Seven, not performing in suit?
Well, that is one of the great unresolved questions for this year, right? Because the Mag 7 are 30% of the index, right? So if you get a rotation out of those 7 stocks into everything else, 493 of the S&P or the Russell 2000, what happens to the index, right? If 30% is tape be up, or is that a more muted tape, even though under the surface the market is broadening, which of course is what's very important. So it's kind of the alpha versus the beta, and I think the alpha is going to work. The beta, I think, is kind of a math question. We know that historically when breadth is extremely narrow, so fewer than 30% of stocks are outperforming the index, it tends to be in rising markets, sometimes peaking markets, so the late 90s, the early 70s come to mind. And when the market is broadening, more often than not, the market goes up. But again, you have this math tension of it being so concentrated.
Do you find that the big tech stocks are more interest rate sensitive and would suffer more from some of the positivity that you're talking about that would keep rates higher?
In part, and when the market started its bear market in early 2022, 2 years ago, almost exactly actually, as of tomorrow, those were the stocks that were initially hit because they are long duration stocks, they're sensitive to interest rates. So it's ironic that that's how the bear market started, and then last summer, those very same stocks, when yields went to 5%, were seen as immune from that because they had so much cash flow, they didn't have to borrow money, they didn't care about interest rates, and of course we had the whole AI vibe going. So it's interesting that same stocks, same environment, different outcomes, but the rest of the market, financials, dividend payers, companies with maybe weaker balance sheets, more interest rate sensitive, that vice of tighter liquidity conditions, when that gets lifted, those stocks can finally lift as well.
I remember you as a young whippersnapper. It was like 10 above zero. Peter Lynch and you were walking down Devonshire. You know, he's in his shirt sleeves with value lines in his hands. And the bottom line, we forget about this, folks, the great Peter Lynch. Fidelity Magellan in 49 years has given me a total return over 15% per year. How much of America's gloomy and doesn't believe in what Lynch and others have done? They don't believe in the equity advantage. To me, it's overwhelming now, the equity gloom that's out there versus a number of decades ago.
Yeah, I mean, it is still the proven store of value, the proven way to compound wealth. And compounding works, of course, not just in the markets, but in careers and everything else. You do a little bit at a time, right? And over the long term, it compounds. It requires patience. Not everyone has patience. And when you have these lopsided market dynamics, that can get lost.
Let me cut you off. Is Lisa Bramowitz and financial media destroyed this because of the immediacy of watching Bloomberg surveillance every day? We don't, we didn't have this media cacophony.
But you know, one of the great things I learned, not so much from Peter, but from his successor, Bob Stansky, was, I would come to him saying, I think the market can go down 10%. He said, good, I can buy some more, because the fund was so big that it took the opposite approach of what maybe everyone in the media thinks. So being a liquidity provider and a liquidity
Why are you looking at
Hold on a second. Just to set the record straight, there is an important role for honest skepticism on the way down and on the way up. And this morning, I've been saying, the fact that the bull case is an up only 9% tells you where people are positioned for total returns. I think it's fair to be skeptical. That's our job.
And Bob Stansky would say, here's the door, Urian Timmer. Thank you so much with Fidelity, of course. It is an eventful 4-day week. It's Tuesday, don't forget that. Jobs, lots of economic data coming up here in the next 3 days. And we'll have all that coverage for you. On radio and television, Bloomberg Surveillance. Good morning.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year. Most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
After some massive gains in 2023, we start 2024 by meeting just a little bit of gravity. Equities are lower. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, starting the year on a 9-week winning streak. Apple receiving a downgrade straight out of the gate, and risk in the Middle East continues to simmer. From New York, we begin with the big issue. Welcome to 2024.
As we enter into 2024. 2024.
We've got an economy that has probably hit a soft patch, but I don't think it's going off a cliff.
We see in 2024 the economy doing a soft landing.
We will actually experience this mythical soft landing.
A soft landing type of scenario. You've got the Fed wind at your back in 2024.
More signs that maybe the Fed is going to be friendlier in 2024.
We are expecting the Fed to cut.
At this stage of the game, I think, it's a question of when the Fed cuts and how much they cut.
Our belief is that they're going to cut 3 times in 2024.
We've been in the March 2024 rate cut camp.
That does seem a bit premature to us.
What I do see in 2024 is a more broadening out of performance.
A broadening out of the market.
The key to 2024 is to be well diversified.
We have seen some incredibly volatile movements in the market of late, and I think it's likely that we're going to continue to see that.
To start the conversation for a brand new trading year, Jim Bianco of Bianco Research, Samir Samana of Wells Fargo. Gents, first of all, Happy New Year, and let's get straight into it. Jim Bianco, how dependent is this market rally on rate cuts materializing sometime soon?
Oh, I think it's very dependent. I think it's really dependent on yields coming down, which are a function of those rate cut rallies. If you look at 2023, you take out the AI, the 7 AI Magnificent 7 stocks, the market was a slog all year until November when the bond market took off and rates came down, and then you had that massive 2-month rally. If we're going to have another slog in interest rates in 2024, and that's what I think might happen, I think you're going to have a slog in the bond market as well. In the stock market as well, too.
Let's go to the bond market first. The 2-year yield down 41 basis points in November. In December, Samir, down 43 basis points. Samir, has this market already cut rates for the Federal Reserve already?
I don't see how you see it any other way, right? Look, we're basically forecasting between 6 and 7 rates if you look at where market pricing is. And then when you look at where kind of equities are with respect to multiples and what they're kind of embedding with respect to earnings growth, it's really the best of all worlds. And I appreciate the seasonality around year end and the start of a new year. There's a lot of hope around. I guess we would fade that hope. Here you've probably, discounted a lot of the year end gains already. This is a great time to build some dry powder and get ready for the next round of volatility. And you may get it on either side, stocks or bonds. So, we're not, tilting one way or the other. We're just going to kind of stay, humble, nimble, and ready to act.
You've said for a while, fade that hope. Lighten up on tech, discretionary, things are too rosy. I remember last time you spoke, to me, at least on this program back in, I think, late November, that meaningful follow-through from here to the upside was unlikely. Then we had something like another 4-5%, Samir. What do you think is going on, contrary to what you were expecting?
It's all liquidity and flows, which, look, in the short run, with January, with those 401k flows coming in, could you go on for another 2, 3, 4, 6 weeks? Absolutely. And that's where, again, for kind of clear-eyed, rational, reasonable investors, I think this is where fundamentals and valuations really kind of help to be a much better guide than kind of flows and technicals, which can almost always overshoot. So, right now, could we keep on going? Absolutely. But I think the real way to take advantage of that is to keep kind of taking some of that, those gains, take them off the table, put them aside as dry powder. And then I think as the year goes, whether it's the elections, whether it's summertime, I do think you'll get some choppiness.
Jim, let's talk about the pain trade. You alluded to it. Last year, the bond market was the pain trade in both directions. We closed 2022 on a 10-year at 387.48. We closed 2023 at 387.91. Now, Jim Bianco, when you think about it, where's the pain trade going to be this year?
Well, given that everybody is leaning towards the idea that there's going to be multiple rate cuts, there's going to be a soft landing, and we're going to have a last mile move to 2% interest rate, 2% inflation, I think the pain trade in the bond market is going to be higher yields as we go through the rest of the year, that maybe we have a no landing. That's what I think we're going to wind up doing. And I think the evidence of the economy, at least through today, is suggesting that that's probably more correct than a soft landing. And so as yields move higher, I think that that's what's going to catch everybody by surprise, just like when yields started moving lower 2 months ago, caught everybody by surprise.
18% expect higher yields in 2024. That was the stat that jumped out for me in the fund manager survey, Jim, that came out from Bank of America going into the holidays. Just 18% of survey participants expect high yields in 24. How quickly has this market become one-sided in both bonds and stocks, Jim, in just a couple of months?
Oh, it's become very one-sided. I think because of the last 2 years, we've seen a 500 basis point rise in the funds rate. People are not used to it, and they're trying to understand it, and that's why you get these one-sided moves. That 18% number is the lowest number in the history of that survey, which goes back about 22 years. And you will wind up seeing it go in the other direction very quickly if rates start going up, because it did back in September and October when rates are going up. So you're going to get these violent moves in sentiment back and forth because of the uncertainty, because no one can remember seeing these types of moves in the bond market over the last couple of decades.
Samir, does that resonate with you?
It absolutely does. I mean, look, as a market participant, when you see people tilted to one side, I mean, it just becomes so clear as to what the right thing to do is. Now, again, could we go further towards a overshoot? I wouldn't rule that out, but with cash still paying 5%, which it really is, with, long rates having come down the way they have, it's probably not a bad place to at least maybe lighten up just a touch on duration. And again, take, kind of profits on the equity side. And I think right now, hanging out short-term fixed income is a pretty good idea for the coming, couple of months.
We're seeing that this morning. Yields up by 8 basis points on a 10-year at the moment. That yield 395.94. Equities pulling back on the S&P by about 0.9%, more than 1% on the Nasdaq 100. This following a downgrade to Apple. Barclays downgrading shares to underweight from equal weight. The stock is negative 2.3%. Katie Greifeld has the story. Hey, Katie.
Rare bear for Apple. According to Bloomberg, Apple has 34 buy ratings, 14 holds, and now 5 sell ratings, the latest being Tim Long from Barclays, cutting Apple to underweight on expectations of soft demand for the latest iPhone. Specifically, Long wrote that his checks remain negative when it comes to volumes and mix for the iPhone 15. Making matters worse, Barclays sees no features or upgrades that are likely to make the iPhone 16 more compelling. And that is a blow, since if you think about a lot of the bull cases for Apple, the backbone of those calls is the Apple iPhone upgrade cycle. Obviously, Tim Long doesn't see a lot happening there. Now, there's a high bar for Apple when you think about this stock. It added $1 trillion in market cap just last year alone, and that's even though it's posted 4 straight quarters of declining revenue, and it faces a lot of uncertainty when it comes to China, both from a demand standpoint and, of course, growing competition from the likes of Huawei. You add this Barclays downgrade to all of those fears, and Apple shares currently lower by about 2.3%, John.
Katie, thank you. Let's pick up on one line that came out of Barclays. And Samir, I'd love your thoughts on this. This is what Tim Long had to say. We believe the continued period of weak results coupled with multiple expansion is not sustainable. Samir, here's the difficulty for a lot of people. That line was true for much of the last year, and yet this stock kept advancing and closed last year higher by almost 50%. Samir, when you look at Apple, it's a little bit of an odd one, that the core good, the iPhone, basically went ex-growth and the multiple on the stock kept expanding. Samir, what would you take away from that?
That's it. That's the key. Is we ended 2022 with really low multiples, especially on those growth stocks, which left room for multiple expansion. And now, as we end 2023, coming into 2024, the multiples have already expanded. So the real question you have to ask yourself is: one, do I expect any more multiple expansion? That's one of those "do you feel lucky" punk types of questions. I would say no. Probably you don't get a lot more multiple expansion. So then, two, the question is: do you get a lot of earnings growth? And we would argue you probably don't get a lot of that either. So that's the tricky part for 2024 for investors. Again, not for traders, not for people trying to play kind of momentum, but for investors, it's very difficult to see how you get the gains from either the multiple or the earnings side.
Samir, what about the rest of the sector? Given the dominance we've seen in tech elsewhere, would you expect the leadership to stick there or shift elsewhere?
I mean, probably six there, but I think honestly, tech probably loses its leadership status as the year goes, especially if you get kind of that no landing scenario. I mean, probably one of our favorite ideas right now is on the cyclical side, right? We really like industrials, we really like materials. Some of the defensives have been left behind, like healthcare, energy. You know, both the commodities and the stocks look really interesting here. So I think there's a lot of places where you can pick up really good value, and I think there's some interesting returns ahead. I just don't think it's tech right now.
Jim, just final word. Is that a view you share?
Yeah, it is a view I share, because I think if you want to get multiple expansion, you'd need lower yields, but that would come about with a weak economy, and then you'd have to question earnings. And if you had a no landing, you would get your earnings, but then you would get higher yields, and you'd have a difficult time with multiple expansion. So you're kind of caught in a bit of a catch-22, and you're hoping for the perfect scenario of just soft enough to, you know, bring down inflation, but not too soft to bring down earnings. And that's a tough one, because you're trying to draw an inside straight with that kind of a forecast.
Jim Bianco, Samir Samana, sticking with us. We are about 20 minutes out from the opening bell. Equity futures near session lows with some movers. Let's get to Abby.
John, before we take a look at the stocks that are dragging on the indexes, let's take a look at one stock that reversed its down move, is now popping higher, and that is Tesla. In the pre-market, Tesla had been down more than 1%, but on a better than estimated fourth quarter deliveries of greater than 484,000 vehicles delivered, the stock is now up more than 0.5%. It looks like there could be some pull through on lower 2024 federal tax credits in that better deliveries number. Microsoft, the second biggest weighting to both the NASDAQ 100 and the S&P 500 after gaining greater than 56% last year, its best year since 1999 on that risk-on rally. Well, today it's starting the year off down 0.7%. And speaking of the biggest weighting, Apple, that you and Katie were just talking about, heading toward its worst day since late October, of course, on that downgrade to Barclays to underweight, warning of that cooler iPhone demand, a bearish tilt to the start of 2024.
Very early days, just a little bit of a soft start. Abby, thank you. Coming up on this program, rising tensions in the Red Sea.
We've got significant national security interest in the region just on our own, the United States, and we're going to put the kind of forces we need in the region to protect those interests, and we're going to act in self-defense going forward.
The latest developments up next.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, you know, in 5 years from now, we will not have sacrificed, you know, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
This is Bloomberg.
One, just to reiterate what I said before, we're going to do what we have to do to protect shipping. Number two, we've got significant national security interest in the region just on our own, the United States. And we're going to put the kind of forces we need in the region to protect those interests, and we're going to act in self-defense going forward. Again, I'm not ruling anything in or out, but we have made it clear publicly to the Houthis. We've made it clear privately to our allies and partners in the region that we take these threats seriously, and we're going to make the right decisions going forward.
Middle East tensions escalating. Iran sending a warship to the Red Sea after the U.S. Navy destroyed 3 Houthi boats. Tehran's move complicating Washington's goal of stabilizing a vital trade channel. Houthi attacks in recent weeks diverting everything from container ships to oil tankers. Shipping giant Maersk suspending all Red Sea transit through today to assess security risk. Your team coverage starts right now with Bloomberg's Anne-Marie here in New York City. Julian Lee over in London. AMH, let's start with you here in New York City. How are they going to contain this risk in the Middle East?
Well, we heard from Admiral Kirby, and when he was asked about there's going to be any preemptive strikes as well on the Houthis, he says, listen, I'm not going to discuss this. We're not putting anything on or off the table. But they said they made the messages clear, both privately through allies, but as well publicly, that they will respond to what the Houthis are doing. Now, we've seen the Houthis go after some of these vessels that are potentially going to Israel or backed by Israel since November. But over the weekend, you obviously saw the risk just escalate and more volatility with the U.S., these helicopters coming from 2 U.S. carriers in the region, following a distress call, 2 distress calls in under 24 hours from this Maersk vessel, and then they were able to sink 3 out of 4 of these boats. So the message is pretty clear right now to the Houthis, but this is really a huge risk to the Biden administration. They want to keep a lid on this volatility, and we saw that potentially happen over the weekend of how quickly the volatility in the region could really escalate.
Is it a risk to commodity markets? Julian, let's go through the prices together. October, down almost 11% on WTI. November, down another 6.25. December, down 5.67. Julian, this is serious stuff. Things are fragile in the Middle East, but if you looked at crude, Julian, you'd have no idea what was going on. What gives?
Well, I think you're absolutely right. I mean, we've seen a rise today of somewhere between 2–2.5% in crude prices, but that's coming off these big falls that you've just mentioned, and we're still seeing Brent below 80, WTI below 75. This is on top of all of the OPEC plus cuts that have been agreed and extended and then deepened for several members coming into effect as of yesterday, and that still hasn't pushed prices above 80 for Brent, 75 for WTI, even with all these tensions in the Middle East. And so I think that these tensions aren't being ruled out, but they are playing out in an environment that is still pretty weak for oil, despite a hefty Chinese import quota that has just been released for the first part of the year.
Julian, how much of this is just about the number 13 million barrels a day of production in this country, in America?
I think that's got a lot to do with it. I mean, the U.S. surprised to the upside on production growth last year. That is putting a lot of oil into the market. That's helping to keep supplies ample to Europe. And that is putting some pressure on the price. The other thing, of course, with the Red Sea, Saudi Arabia in particular has the ability to bypass the southern Red Sea for its oil exports. Its shipments to the US, such as they still are, either go already round the southern tip of Africa or across the Pacific to the west coast. Its shipments to Europe can be loaded onto tankers sort of 2/3 of the way up the Red Sea and carried northwards through the Suez Canal, thereby avoiding all these areas of tension. It's really the other barrels coming out of the Gulf, particularly Iraqi barrels heading to Europe that have, to some extent, replaced the Russian crude that's not going anywhere, and it's those that are most at risk.
The latest number on the Bloomberg terminal right in front of me, Anne-Marie, 13.3 million barrels a day. Is that still the quiet boom in America that this White House won't talk about?
Well, the world has been more awash with U.S. production and shale oil as well, Jonathan. The issue for the Biden administration is not going to be the oil market when it comes to the Red Sea, although, of course, they're going to be concerned to make sure that oil is flowing through these tankers. But it's consumer goods that is really the concern. But it is because of that, north of 13 million barrels a day of U.S. production. Sometimes the administration doesn't love to tout this, because remember, the president ran on being a climate president. They want to lean into electrifying the grid and all that they are doing on the climate agenda, but it is an incredibly historic number, this record production we see out of the United States.
AMH, thank you. Alongside the brilliant Julian Lee, to the both of you, thank you. Brent crude right now, 78.18, WTI 72.74. Jim Bianco, Samir Samana back with us. Samir, you mentioned energy. Let's talk about it. What reasons do you have to believe that that crude price is going high sometime soon?
I mean, look, I think at the end of the day, it looks like the Chinese are finally starting to get a little bit of traction on some of their stimulus. I think the OPEC supply cuts, because they were somewhat voluntary, are being underappreciated. I think the fact that the SPR at some point has to refill is kind of lingering out there, and they seem to want to do it in the low 70s. And then when you think about the fact that it's possible that maybe there is no landing, all those things tell me that the one trade that has probably the most ability to catch up is probably crude oil. And then I would say energy equities probably rally alongside that. The fact that it's down here in the low 70s is probably the one asset class that probably does okay in a recession, just because it is so beaten down, but does really, really well if there really is a soft and or no landing.
Jim, do you agree?
Yeah, no, I definitely do agree. I think that oil is really going to be more of a demand story than it is going to be a supply story. And the demand, as Samir said, is probably going to be about China. They've had a difficult reopening after zero COVID a year ago, but maybe they're starting to get some traction. And that means that they're going to have more demand. And oil is a fungible commodity. Doesn't matter where it's made, as long as it's being consumed in greater amounts. And that should help to push the price higher as we go into 2024. And if OPEC plus, that is OPEC plus Russia, holds resolve to their 1.5 million barrels of cut a month, then we should probably see higher oil prices.
Jim, let's put a bow on it. We've spent the last 20 minutes or so talking about the potential for various pain trades. When you look at the range on Wall Street at the moment, Jim, and I know you've looked at the same numbers as me, at the high end 5,200 from Oppenheimer on the S&P year end this year, at the low end 4,200 from JP Morgan. That range, Jim, is 1,000 points wide. Just how much conviction is there on Wall Street for the year ahead?
Well, I don't know if it's so much conviction as it is about assumptions. You know, I've been arguing for a couple of years now, what did 2020 mean for the long-term outlook for the economy, that complete shutdown restart of the global economy, the reboot? If you think not much and you keep using words like rebalance and renormalization, you're probably towards the higher end of that scale, about 5,200. If you think that it has some long-lasting effects like remote work, deglobalization, maybe, you know, energy being more of a political weapon, you might be at the lower end of that schedule. So I don't know if it's the lack of conviction as it is, what do you think 2020 meant for the longer-term outlook for the global economy and financial markets?
Samir, your response to that. Final word, please.
Yeah, I mean, look, I think here it's pretty clear. I think you've got to fade risk. I think you probably fade long-term rates just because you are getting paid so much in cash. I think you try and find those idiosyncratic opportunities like energy. But I think right now, just given what's gone on in the last few months, I think it's just a really great time to play a little bit of defense and just, you know, take a flyer on the fact that maybe consensus, as they were in 2023, is a little bit wrong right now.
A strong start to the year, gents. Appreciate it. Good luck for 2024. We'll catch up, no doubt, in the next few weeks, the next few months. Jim Bianco, Samir Samana. Speaking of consensus for last year being wrong, just remember, average forecast on the S&P 500 last year was 4,000 points. We finished last year almost 20% above that average forecast. Coming up on this program, the morning calls, and later, if tech goes, so does the market. That's the warning from RBC Capital's Amy Wu-Silverman. She'll join us around the opening bell. That opening bell is about 7 minutes away. Equity futures near session lows. We're down about 0.75%.
much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
5 minutes away from the opening bell. Equities pulling back just a little bit on the S&P 500, a little bit more on the Nasdaq. We're down almost 1% there on Nasdaq 100 futures. That's the price action. Let's kick things off with some morning calls. 3 of them. Here's your first. Barclays downgrading Apple to underweight. 160 price target, saying recent channel checks point to weakening demand. Your second call from Deutsche Bank downgrading Estee Lauder to hold, seeing limited upside due to macro headwinds and crowded inventories. That stock is negative by almost 2%. And finally, your third and final call from D.A. Davidson, downgrading Hasbro to neutral, growing increasingly concerned about the company's expensive valuation. That stock is negative by about 1.63% to 50.23 in the pre-market. Coming up on this program, RBC Capital's Amy Wu Silverman expecting a volatile year ahead for equities. That conversation about 4 minutes away with equity futures near session lows. Your first opening bell of 2024 up next.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things we have this great connection about the love for baseball, and the reason why Warren and I got to know each other is he insured my contract, the 252, and I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, Bloomberg. Context changes everything.
Seconds away from the opening bell, the first opening bell of 2024. Happy New Year to you all. In the equity market, equity futures pulling back by 0.75% on the S&P, on the Nasdaq 100 down about 0.9% following monster gains in the year 2023. On the S&P, 24%. On the Nasdaq 100, 54. There's your opening bell. Switch to the board and get to the bond market. Yields aggressively lower. December, November, this morning a little bit higher, up by 7 basis points, 394.63. The dollar, with its first down year on the year last year since 2020, showing some strength this morning, 109.52. That currency pair negative 0.8%. Tensions in the Middle East. Crude still sold off October, November, December this morning, advancing just 0.7%. $72 and about 15 cents. As we kick off trading for a brand new trading year, 2024, 30 seconds into the year, equities pull back by 0.6% on the S&P. On the Nasdaq, down by around about 0.9. Responsible for some of that move, this one stock, Apple. Barclays downgrading the shares to underweight from equal weight. Abby has the story. Hey, Abby.
Hey, John. Yes, we do have Apple starting the year off with a bit of a bearish bang, down more than 2%, heading toward its worst day since late October. And this, of course, as we do have Barclays cutting shares, taking advantage of what can often be a quiet news day for stocks, taking advantage of that, cutting the shares of Apple to an underweight from equal weight. Analyst Timothy Long saying that channel checks show that demand for the iPhone 15 lackluster, expecting the same could be true for the iPhone 16. In addition, he does not expect services to grow more than 10%. And he's saying that there's not a quote-unquote bounce back for the Mac, iPad, and wearables. Now, the heart of his call relative to price action is the idea that last year you had the shares of Apple up more than 48%, despite the fact that some of the numbers were disappointing. He's saying we're going to see a bit of a reversion. He thinks holiday numbers or the upcoming report will be okay, but he's lowered his March numbers once again below consensus. He's lowered his price target, as you mentioned earlier, to 160 for a roughly 15% drop from here, potentially for the shares of Apple.
Abby, thank you. I've said a few times already this morning, really hitting the ground running to start this week and to start a brand new trading year. Payroll's coming up on Friday. Next week, the following Friday, earnings from JP Morgan to unofficially start earnings season. Some delivery numbers as well from EV automakers too. Tesla topping Q4 estimates. Rivian falling short. Ed Ludlow on the West Coast with more. Morning, Ed.
Yeah, good morning, Jonathan. Tesla currently higher, 0.3% It's paired the earlier gain that it had following the market open. In the fourth quarter, 484,507 EVs delivered by Tesla. That was ahead of estimates, and it does mean that Tesla exceeded its target of 1.8 million vehicles in 2023. Go back to a year ago, January 2023, the first earnings call of the year, where Elon Musk said that 2 million units would be possible in the full year. So they beat the 1.8 million official guidance, but it fell short of that kind of higher bound target that Elon Musk had outlined. There's a number of storylines within it, because even though Tesla exceeded its own targets and the stock is higher by a few tenths of a percent, BYD, the Chinese EV maker, delivered 526,409,000 EVs in the quarter gone, meaning it now holds the crown as the standalone biggest maker and seller of electric vehicles. And of course, it has many more cheaper model variants in that domestic Chinese market. You also mentioned Rivian. Sequentially, quarter on quarter, deliveries fell short of estimates, even though for the full year, production of above 57,000 quite comfortably exceeded what was largely seen as conservative production guidance of 54,000. Rivian is a story of teething problems, right? A new EV player getting vehicles to customers, but there's also a demand question going forward too, John.
Ed, you and I are going to talk about this in about 10 minutes' time, but let's have a little tease of the next segment, shall we? Who gets EV tax credits and who doesn't? How's that going to play out this year?
You know, the rules have changed. They are now basically 13 eligible models for the full $7,500 tax credit. It'll be interesting to see the maneuvering, right? What can the automakers do? Can they do anything to lower price, change variation on model lineup to increase eligibility?
Ed, thank you, mate. We'll catch up in about 10 minutes' time. That stock is lower by about 0.8% on Tesla, about 4 minutes into the session. The latest from Dan Ives of Wedbush, reiterating his outperform rating on the stock, saying this: the price war in China has finally hit a calm period, which is music to the ears of Tesla bulls. This was a clear win for Musk. Hitting 1.8 million vehicles was a major achievement in a choppy macro environment for EVs. Their stock is now down by a little more than 1%. Let's turn from autos to airlines. Evercore downgrading Southwest to inline after a big rally into year-end. Simone Foxman on top of this one. Hey, Simone.
Hey, John. Yes, shares of Southwest now down about 1.8% in very early trading. Dwayne Fenningworth at Evercore ISI maintaining his $35 price target, still about 21% higher than Friday's close for this name, but saying margins really below their long-term potential and Southwest growth not keeping up with the overall growth in the U.S. economy. He's much hotter, however, as are most analysts, on Delta. Delta shares also falling today, but this is TD Cowen's best idea for 2024. We got reports over the weekend that Delta is telling pilots it's only going to hire 1,100 pilots. It had hired more than double that last year. This may be something that keeps, its costs more in line with pre-pandemic levels. But expect a turbulent month for airline stocks, especially here in the U.S. AAA said it was the busiest year-end travel season in history since it started tracking that data back over 20 years ago. We're watching the outcome of a DOJ trial about the JetBlue and Spirit merger that could have big impacts for the broader sector. And then, of course, you've got the consumer in China. China said they had seen a surge in domestic tourism sales up 5.6%, but our Bloomberg second measure data saying U.S. sales slowing by 6% in the week ending December 24th. So lots in play there.
Simone, thank you. Just look at the close of the year. The rally into year-end for some of those airlines on the S&P 500. November up by 15.51% for those names on the S&P. December up another 8.5. Really strong finish to 23 for the airlines on the S&P. Let's turn to the food space just briefly. According to the FT, DoorDash planning to diversify beyond delivering meals. Katie Greifeld on top of this one. Hey, Katie.
John, yeah, it's an interesting move for DoorDash. Obviously, the bread and butter of their business is delivering food to doors, specifically in the United States. Now the company looking overseas as well. DoorDash CEO telling the Financial Times that the company's two largest areas of investment are expansion and penetration outside the U.S. Now, if you think about DoorDash's expansion strategy so far, it's been to target smaller markets that its competitors haven't yet broken ground. Remember last year, DoorDash expanded into Austria and Iceland. They did that through a partnership with Helsinki-based Wolt. And according to the FT, DoorDash job postings suggest that the company is looking to move into Luxembourg as well. Now, news of these plans comes as DoorDash is looking for ways to invest its growing cash pile. You look at the 12 months ending in September, and DoorDash had generated nearly $800 to $900 million of free cash. So quite a chunk of change there. So it makes sense that DoorDash would be looking at new markets. Shares are currently a little bit lower, less than 1%. But remember, DoorDash was nearly 100% higher last year alone, John.
Amazing. Katie, thank you. Small move lower. We're down by not even 1 percentage point. About 7 or 8 minutes into the session, your start of 2024 trading looks like this. We're down about 0.5%, 0.6% lower on the S&P. On the Nasdaq 100, down by a little more than 1% after a gain of more than 50%, 54% higher for 2023. Here's the outlook from RBC Capital's Amy Silverman, weighing in on the year ahead, writing this: I expect a year of mean reversion and normalization for volatility, a year filled with both geopolitical risks and political ones, like the US elections. Amy, I'm pleased to say, joins us right now. Amy, as you often do, as you always do for us in your brilliant way, lift the lid on your universe and tell us, what is the big bet right now?
Well, look, it's hard to believe, John, that we're now 4 years away from the pandemic. And a lot of what has happened in this cycle has been really unique, really odd in the options market. Relationships, correlations that we typically count on pretty much went the opposite direction. I think this is going to be one of the first years where we start to see mean reversion. We start to see normalization. What I mean by that is I think there'll be a demand for hedges. Equity skew is something that all but disappeared in our market because folks are much more focused on getting upside. I think that starts to change. And I think the overall level of volatility reflation is something that we'll also see in 2024.
In terms of specific trades, you alluded to this going into year end. Do you think as we start this year, we're revisiting some of the trades that didn't work last year?
Yeah, that's exactly right. You know, when we kind of look back to the last 3 years, a lot of things that historically tend to work really haven't. And last year was a year, John, where it was actually just better if you just didn't do anything at all. You had the S&P up 20%. Not a single option strategy on a systematic basis beat that. But, you know, I think we're getting to a point where it really is about how we're positioned in the boat. We were in a year last year where folks really weren't well positioned on the long side. We're much more full up in that regard. And I do think that's one reason why people will start to consider downside hedges, not necessarily because there are risks out there, even though I think there are. Actually, just simply the fact that they have something to hedge is why we'll see something like equity skew start to pick up. And I've said on your program many times, John, that the tails in the market, especially in options, are really at historically low levels.
There's always a ton of event risk on the horizon, always, every year, looking out 12 months. Amy, this year, no different. We need to talk about elections. I'm going to use some of your language from you and the equity team, I'm sure including Laurie Calvasina. Why is talking about presidential elections like staring at the sun for you and the team? Amy, why is that?
Yeah, no, that's I'm definitely borrowing Laurie's phrase there. But, you know, when we speak with investors, it's something that just falls in the category of very unquantifiable. And, you know, I hate to use the word unprecedented, but look, we're going into a year right now where, you know, a potential presidential candidate isn't even allowed on the ballot in 2 states so far as we kick off the new year. You know, we really don't know how to price that. And I'll tell you, the way the options market is pricing that is simply not at all. Now, I think that is also a function of November being quite far away in terms of elections. And we've seen a lot of tenor shrinkage in the options market. But beyond that, you know, it's very difficult to have a concrete way to price that outside of saying, okay, what other ballots could we see this being a risk on? You know, when are the primary? So right now, equity options are quite low. They're not pricing in the uncertainty and the risk that comes with elections. And if you look back to something like 2000, when we were talking about hanging chads, and there was just simply a question of who is on the ballot, who is the president, that was a year where we did see volatility spike.
Amy, you mentioned it. I want to build on it. The volume now that goes through 0 day to expiry options, given where November is so far out, you've mentioned this and you've talked about it in your research as well, whether options and your universe can be used as an early warning of anything now, given where the volume is and where the volume isn't.
Yeah, this is a very unfortunate nuance that I think if you're not day-to-day in this market, you know, you don't quite pay attention to as much. But the options market used to be this great early warning system. You know, it would tell you where the concerns are 1 month out, 2 months out, 3 months out. The issue is when you have so much volume, S&P almost 50%, going through something like 0 day to expiry options, that warning signal has become shorter and shorter and shorter. It's one of the reasons folks keep asking me why headline VIX looks so suppressed, because people aren't using it. You know, people are using these far shorter dated tenors. I just saw the CBOE say that they're going to start to do 0 DTE on small caps on the IWM proxy. So you're going to see that not only in S&P, but in other underliers as well. And so you can't rely on that early warning system. And I think what that could create is sudden pockets of volatility that people are not prepared for.
Interesting. Amy, thank you for the update. As always, we'll catch up soon. And a Happy New Year to you and the team. Amy Silverman there of RBC. About 12 or 13 minutes into the session, pulling back by, let's call it 0.75% on the S&P. I don't think you could talk about that move without talking about the move over the last 12 months. Last year, of course, a 24% gain on the S&P, 54% on the NASDAQ 100. The NASDAQ this morning down by more than 1%. Coming up, US-China tensions simmering under the surface.
Part of this is also external to China. It's the U.S. push to move supply chains away from China. So there's both a push and a pull factor here at work.
From chips to EVs, that conversation up next.
do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. We don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Breaking economic data for you. Mike McKee has the numbers. Morning, Mike.
Good morning, John. Well, everybody, it's tough to come back to work, and maybe tougher if the economic data don't go your way. Although I came in this morning and there was an analyst who said that the market's looking for a reason to fall. If you need a reason, this is the best I got for you. The S&P Global Manufacturing PMI falls to 47.9 from 48.2. The expectations was it would rise to 48.4. So a little bit of a disappointment there. Normally this comes out the same day as the ISM, but with the calendar being what it is, the holiday this week, ISM comes out tomorrow. It's expected to rise to 47.2 from 46.7. So we'll see if that carries through. And if not, then we'll have an interesting Wednesday.
Just how relevant, Mike? ISM manufacturing, I'm looking at the numbers, sub 50 since late 2022. There's been numbers to focus on and numbers to ignore. Is that in the latter bucket?
No, it's not a number to ignore. Basically, people follow it for a lot of the sub-indexes as well. They're going to be looking at prices, they're going to be looking at orders, and of course, they're always going to be looking at the jobs number, trying to get a hint for what happens on Friday.
Payrolls just around the corner, Mike McKee. What are you looking for?
Well, along with all the other data that comes out on Thursday, we get ADP and jobless claims. And don't forget JOLTS tomorrow. Everybody loves JOLTS. But the December payrolls is the highlight of the week. And what's expected is 170,000, which is a bit down from where we were last month, but it's still very strong. Unemployment's supposed to tick up to 3.8%. That's only one tick higher than it is now. So it doesn't make the case that the economy and the labor market are slowing down a whole lot. That's what people are going to be interested in coming this week.
Mike McKee, thank you, sir. Looking ahead to your coverage of it. Looking forward to it. Mike there. Happy New Year, Mike. Appreciate it, buddy, as always. Data to focus on, jobless claims. If you're focused on that and nothing else all year, spoke to the resilience, the strength of the U.S. economy for the whole of 2023. Let's talk about China and the United States. On the surface, President Biden and Xi are playing nice. Under the surface, divisions are growing. Biden's cracking down on China's semiconductor ambitions. Dutch manufacturer ASML bowing to D.C. pressure, cancelling China-bound shipments just weeks before export bans kicked in. This as the U.S. slashes its list of EVs eligible for tax credits to exclude vehicles with certain Chinese-made parts. Here's your team coverage with Katie Lyons in D.C., Ed Ludlow in San Francisco. Ed, you and I mentioned it, just that division growing between China and the U.S. and what will be eligible and what won't be eligible for EV tax credits.
Yeah, you have a situation where if you're trying to onshore an industry, be it EV supply chain or semiconductor, the onshoring and subsidies going hand in hand with sanction to sort of make competitive against the foreign market. The new rules eligible as of January are basically dependent on the battery and battery components having a threshold of how much Chinese ownership the company that makes them has. It's set at 25% limit. So if any part of your battery pack or battery components have some ownership by the Chinese government or a Chinese state-backed entity, you've got to look for alternatives. You asked me in the teaser ahead to this segment, well, what can the automakers do? The answer is that they're working with the White House directly to adjust that supply chain. The net effect is that when there were perhaps 24 vehicles eligible for the full $7,500 tax credit, those component rules now mean there's only 13. That's the impact. It's basically halved the number of EVs you can buy that are eligible for a full credit.
So, Kaylee, we've got to draw a distinction between the rhetoric and the policies. Now, the rhetoric's a little bit better over the last couple of months. She's speaking nicely about the relationship between the US and China, Biden doing something similar in the last few months as well. Kaylee, when you look at the policies, do you see a different story?
Well, it's a story of competing objectives, frankly, Jonathan, because on the one hand, yes, the U.S. is pursuing a normalization of the relationship with China, and they want to cooperate. But at the same time, they also want to compete, and specifically, they want to protect U.S. national security interests. And that really is what these export restrictions and other controls are about, trying to limit China's access to certain critical technology. And semiconductor technology in particular is included in that. Hence, according to Bloomberg's reporting, the U.S.'s push to get ASML, of course, a Dutch manufacturer, to cancel or halt immediately pre-scheduled shipments of key lithography equipment. Some of those machines that were scheduled to go to China have now been halted weeks before those actual export restrictions kicked in. So that just reinforces this idea that the U.S. is trying to limit China's ability to develop its own semiconductor industry. Again, competing objectives here. And this comes back to the EV conversation as well, John, because yes, there is the objective to wean U.S. industry off of these Chinese components, A, because of national security interests, also the desire to support U.S. manufacturing specifically, but you also have a president who is pursuing a climate agenda, and this potentially runs into conflict with that.
One of the relationships to watch for the year ahead. Ed, thank you, alongside the brilliant Kelly Lyons down in Washington, D.C. Here's the broader price action for you. If you're just joining us as we kick off 2024, we're pulling back on the S&P by 0.7%, on the NASDAQ down by 1.5%. The one stock to watch around the open all morning, actually, has been Apple. A downgrade from the team over at Barclays from equal weight to underweight. I'll give you some of the explanation, just a line for what they had to publish this morning. We believe the continued period of weak results coupled with multiple expansion is not sustainable. Their stock is lower by more than 3% now. Let's get you some sector price action. Here's Abby.
We do have a broad-based sector decline today, John, weighing on the S&P 500, the worst day in nearly 2 weeks. And taking a look at sector-wise, it looks like a few are higher, but those are defensive sectors. You have healthcare, utilities, and staples, and real estate, all higher. Real estate actually growth, but the other three are defensive. So the fact that they're higher, that investors going toward defensive sectors is a bit risk off. And then take a look at the technology sector. We also have the other two mega cap tech sectors down, but down 2.5%. We have 62 of the 64 components lower. The worst day since early August. So that Apple downgrade and yields higher really weighing on big tech today, John.
Abby, thank you. The latest moves in big tech, Apple, and a broader market specifically. Coming up on this program, we'll get to the trading diary, a sneak peek of the calendar for the first week of 2024. That's next. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
From New York City this morning. Good morning and Happy New Year to you all. About 26 minutes into the session, equities pulling back on the S&P by 0.8%, on the Nasdaq down by something like 1.6%, following 9 weeks of gains on the S&P 500. The equity bulls have been absolutely spoiled. That is the longest weekly winning streak going back to 2004. Can we snap that this week? Early days, but the S&P is down by about 0.8% as we kick off trading in 2024. Here's the week ahead, the trading diary, the calendar shaping up as follows. ISM manufacturing numbers and JOLTS data coming out tomorrow, followed by the Fed minutes at 2 p.m. Eastern. Did they? Didn't they talk about rate cuts? Did they kind of talk about rate cuts? We'll find out what they publish in the next 24 hours. Thursday, another round of jobless claims. Friday, it's the main event. It's the payrolls report just around the corner. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day and the trading year. This was the countdown to the open. This is Bloomberg.
What do you worry most about your economy and Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean? I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience, the first trading day of 2024. Let's look forward. We're going to do that with Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. He's going to join us. And then Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence. Get her thoughts about this 2024 outlook after just a gangbuster end of 2023. Mike McGlone, Senior Macro Strategist with Bloomberg Intelligence. He's ensconced down in Miami Beach, Miami. He's our commodities guy. We're going to talk about all the commodities, including Bitcoin. So we got a lot of Bloomberg Intelligence smart folks coming up in this hour. Kick this off right now down in Washington, D.C. with Amy Marshall with Bloomberg Business Flash.
All right, thank you, Paul. This Bloomberg Business Flash is brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of more than 1 million global fixed income securities with no markups or built-in spreads and low transparent commissions. Learn more at ibkr.com/bonds. Apple got itself a new bear as expectations of soft demand for its latest iPhone prompted analysts at Barclays to downgrade the stock. We get more on this from Bloomberg's Kriti Gupta.
They're actually cutting their rating to underweight from equal weight earlier. You know, when they performed their channel checks, they showed weakness in iPhone volumes, and get this, a lack of bounce back. That is a direct quote in Macs, iPads, and wearables.
Bloomberg's Kriti Gupta. And Apple shares are now down more than 5%. We check the markets for you all day long here on Bloomberg Radio. S&P down 0.5% or 27 points. NASDAQ down 1.3% or 203 points. The Dow is little changed, down 10 points. And the 10-year Treasury at 3.92%, the 2-year yield at 4.31%. NYMEX crude oil has a gain of 0.1% or 7 cents, now trading at $71.69 a barrel. COMEX gold up 0.3% or $6.40, now at $2,078.20 per ounce, and the euro at 1.0967 against the dollar. I'm Amy Morris. That's your Bloomberg Business Flash. Paul and Mike.
Amy Marsh, the pride of the University of South Carolina. Thank you so much. We appreciate that. Michael Regan, co-hosting here for the next couple. How'd you get ringed into this? I mean, you see what happens when you.
I won the lottery, Paul.
Exactly, you won the
Paul Sweeney lottery
in the rotating seats of co-chairs for Bloomberg Markets. Interesting stuff here. So we got Mike Regan, we got Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio, and that's where you will find us. Let's get a sense of what's happening here with markets. Vince Signorella joins us via Zoom. He is the king of Zoom. Vince, here we are, first trading day of 2024. How do you think traders that you speak to, how are they prepared to start out this year, do you think?
Well, I mean, generally speaking, most traders start out the year slow. You don't want to give the year away in the first week. I was probably the exception to that. I seem to always do that for some reason. I'm always trying to catch up in the rest of January. So there's usually a pretty slow start, just kind of like, almost like the first round of a boxing match, just feeling your way around, trying to get a sense of markets. We're seeing equity sell off this morning. Dow's actually back to little changed, but the NASDAQ's taking a bit of a hit. And when traders are telling me that's a lot to do for tax reasons, and be curious to see what Gina has to say about that. I'm sure she knows more about it than I do. But what they're telling me is they're jockeying for income tax reasons. That's what's going on in the tech space, and so I guess you can't read too much into that all by itself.
Yeah, but Vince, at the same time, we did see this ferocious rally in equities last year. Decent bond market, at least it wasn't down for a third straight year. Is there concern, though, that there's more than just a sort of a one-day blip here, that maybe the equity market is due for a little bit of a cooling off?
Yeah, no, I think there's a real concern of that. I think the calls for quote-unquote recessions slash soft landing are not unrealistic. There's a reasonable chance that that's a possibility. I wouldn't say necessarily a probability, but it's certainly a very good possibility. And I think that's why we're seeing the Fed react as they are, walking back any future rate hikes as they did 2 meetings ago. And now we're in the camp of, we're going to cut it sometime. Even though they've walked back the timing of it, I think they're just trying to be cautious because they're data dependent and they want to see how the data plays out. But I think there's a reasonable probability actually that they go in March if the data gives them reason to do so.
And now with a little bit of hindsight, most people had a few days off there over the new year. Looking back on the performance, Vince, that we saw across equity markets, bond markets, really since late October, just the surge in a risk-on feel. With a little bit of hindsight, was that reasonable, or do you think the market just kind of overshot it a little bit? But it seemed like just such a big move there in a short period of time.
Yeah, I think in a sense a little bit of both. There was a bit of FOMO going on in the fourth quarter. As you guys are aware, a lot of the major analysts, if not most of the major analysts on the sell side, got this dead wrong, and they probably had to do. There had to be some window dressing going on at year end to make up for some of those bad calls. Where I think more than most were looking at an S&P close at around 3,500. And so there was some of that, and this is, it's not necessarily going to carry over into the first week of the year. I'd like to see how the data plays out. You've got jobs data coming up. That's probably going to be a key. I don't think that's going to change what the Fed is thinking at the moment, but it may change where traders are pricing things, at least the timing of what the Fed may be doing. But it certainly did seem a bit of, as Mr. Greenspan used to call it, irrational exuberance going into year end. And you certainly wouldn't be surprised to see a little back and forth trading into, especially the first week. Say some people selling for tax reasons, other people maybe getting in, looking for opportunities in some of those sell-offs for some of the bigger names that they have some good long-term feels for, not necessarily short-term.
Vince, you're talking about that jobs data at the end of the week. The average economist estimate is about 170,000 jobs added in the month of December. That is sort of on the lower side compared to what we've seen in the last year or two. How do markets react to either a beat or a miss? Are we back in that sort of bad news is good news for risk markets type of scenario?
I think so. I think you make a good point, Mike. I think if those numbers came in weaker than expected, I think the markets would see that as good news, only because the labor market's been relatively strong. So a pushback in jobs data is not going to give people a feel that the economy is rolling over too much so, but certainly rolling over enough to give the Fed better reason than not to go at the March meeting. And of course, that's also probably going to be good for risk. We should see a bit in the bond market, which should help equities, probably weigh on the dollar a little bit, especially dollar yen.
So, Vince, WIRP GO, the world interest rate probability function on the Bloomberg terminal. When I first was shown this, I said, boy, this is a cool function. Tells you kind of where the market thinks interest rates are going to go. I could make some money with this. But then I realized it's not very accurate. I mean, and I kind of learned the hard way that you guys really don't know what you're doing out there in the marketplace. But right now, it's talking about 6 or 7 rate cuts this year. What do you think?
Yeah, there's a little bit of dreaming going on in the work calculations. You also see it in the swaps market with traders. You have to understand, I tell that to people all the time. Don't rely on the swaps market. This is what traders are trading today. You don't want to stand there and go against the entire market and get run over. And so, you need to take all of this with a grain of salt. every time a major data point comes out, call it jobs, CPI, PCE numbers, things along those lines, that misses the mark of what estimates or economists are estimating. You're going to see that swaps market priced differently, and you're going to see the work market priced differently. And I just look at those, if I were still trading, as opportunities to fade the over aggressiveness of the market, if you will. Economists have the luxury of missing their expectations because they don't have a P&L, as traders do. Yep. So, when they miss, they just say, oops, and they go back to the board and start all over again. So, traders tend to overreact to those moves. But that's the way the market is. Those are, what an old boss of mine once called good trading conditions.
All right, Vince, thanks so much for joining us. Really appreciate it. Vince Signorella, Bloomberg's market strategist, Bloomberg News. You can check him out on Squawk, SQUA, Go on the Bloomberg Terminal for market timing and market commentary throughout the day. All right, let's go to Ira Jersey. He's our chief U.S. interest rate strategist. I just saw him on Bloomberg Television. Now he's on Bloomberg Radio. He's got to have something important to say if both television and radio booked him on the same day. Ira, thanks so much for joining us here. I'm looking at INGO, the Bloomberg Index browser, and I see the U.S. Treasury market was up, I guess, positive 4.05%. So you guys actually made some money in 2023. Surprise, surprise. What are you looking for in 2024?
Yeah, so I think a continuation, actually maybe even slightly better returns than that in 2024. Partially because even if the Fed doesn't cut as much as the market's currently pricing, because I personally don't think that we're going to get the 6 interest rate cuts that are currently being priced into the market. But even if we don't get them this year, the market's going to keep on thinking that longer term interest rates are going to be lower in the future than they are today. So we'll continue to get a little bit of a lower yields, which means higher prices, which means better Treasury returns. So you probably get your coupon plus a couple more percent on top of that. So we're talking about more like 6-7% Treasury returns, which really is not crazy, right? That's not incredibly high compared to the recent past, but it's not bad, right? Yeah. I think the thing is and this is what I'm worried about, Paul, is right now, and the way that I'm thinking about what we're priced for right now versus where I think we're going to end up at the end of the year, is we're going to see a lot of volatility, I think, the first half of the year in the rates market, right? Going into the election, will the Fed cut? Won't they cut? Are we going into a recession? Are we not? And I suspect that the market's going to come to the realization that a recession isn't imminent, and because of that, we'll price out a few, maybe 2, 3, 4 of those 6 cuts that are currently priced. That'll cause Treasury yields to rise again, and you wind up with 10-year yields maybe selling off early in the year, but ultimately we probably rally the back half of the year, not dissimilar to what happened in 2023.
Ira, that trajectory of inflation going forward, I feel like is still going to be a topic of conversation this year. It seems like a lot of people are convinced mission accomplished. We've beaten this inflation tempest. The Fed has succeeded. But I'm curious what you're seeing. I know you keep a close eye on the break-even rates, sort of the bond market's best guess of where inflation is going. What is the story to be told looking at those numbers?
Yeah, so when you look at inflation break-evens by the TIPS market or inflation swaps, I think that might be one of the more mispriced parts of the rates market. We're priced for basically 2% inflation from now for the next 2 years. And that's completely possible at the headline level, particularly if oil prices don't rebound and even continue to fall a little bit further. But inflation, the problem with inflation right now is kind of the easy inflation declines are behind us, and we still see pretty strong inflation in places like services, which are a very large part of the economy, large part of the inflation baskets. And because of that, the next 50 basis points of fall are probably going to be a bit more difficult than we've seen over the last 6-7 months, when you've seen pretty deep declines. In fact, you had goods prices actually contributing negatively to inflation for a couple of months, and if that probably won't persist for the long term, particularly if we do get more geopolitical tensions and supply chain issues, which again, those were the easy things that no longer exist. So I do think that inflation might stabilize. We're not going to reach, I don't think, the Fed's 2% until very late in the year on a year-on-year basis. Jobs not done yet by the Fed, but I do think that the worst of inflation is behind us for sure, and the market's priced for that, right? That's exactly what the market's thinking. So it wouldn't be a huge surprise if inflation kind of stabilized, I think, here 2.25%, 2.5% over the next couple of years.
Ira, I'm looking at the 10-year Treasury. It was, kind of late October. It was around 5%. Here we are at 3.93%. Where do you think this 10-year might be at year-end 24?
Yeah, so our forecast is for 10-year yields to go down further, down to 3.22% is our current year-end forecast. 3.22, yeah, nice. Another 70 basis points. So again, like compared to the 120 basis points we rallied just in 2 months, people look at me funny when I say that, and I'm like, look, we just rallied 120 basis points. I'm talking about going, 7 basis points a month from now until year end. That doesn't seem unreasonable to me. Now, but again, it won't be a straight line, right? It'll be like we sell off 15 basis points this month, then we rally 30 basis points next month. That's the kind of volatility that I suspect we'll see. It won't be a straight line. We'll continue to rally. But that's where, when you ask me about the kind of returns that we might get, if you were to buy today and our forecast were to pan out, you get 3.9% on your coupon, right, on just interest, and then on top of that, the market will rally just a couple of percent in terms of price because of the 70-ish basis point rally down to 3.2%.
Ira, we are seeing a bit of a sell-off today, specifically in bond markets across the world. I know you've worked as a strategist for a long time, but also as a portfolio manager. Is there something about the first day of the year that could trigger a sell-off, even though the outlook is for lower yields, like you're saying? Everyone talks about window dressing at the end of the year. Is this kind of the opposite of that we're seeing today?
Yeah, not really. A lot of times you'll see people, exit positions just because they're thinking about how they want to be positioned going into the next data point, or how they're thinking about being positioned for the next year. I think a big thing that happened last year was people who were short the market or underweight duration going into October said, okay, look, we hit it. We got to 5%. We made a fair bit of money being underweight duration. Let's get flat now. And that was one of the big reasons. So short covering basically was one of the big reasons. Now I think, it looks like a lot of the positioning data suggests that we're more balanced. So now I think people are just reassessing, hey, where are we? What do we think the actual economic outlook is? And one of the reasons, we're selling off is because, we're priced for the potential for a cut in March. And I think a lot of people are saying, just some of the people I was talking to this morning, were suggesting, like, hey, maybe that's a little bit too optimistic or pessimistic in terms of the economy. Let's lighten up on some of the long positions we've had and just lighten up here. And the market's still not very liquid, so I wouldn't suggest that a 5 to 7 basis point sell-off or rally is that meaningful anymore compared to what it was, say, 7 years ago when interest rates were basically at zero and the market was incredibly liquid.
Ira Jersey, thanks so much for joining us. As always, Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, joining us via Zoom from the Bloomberg Princeton, New Jersey campus here. Bitcoin up 3.3%. Mike, that's on that speculation that we're going to get that ETF?
Yeah, that's the sort of perennial driver of Bitcoin these days. Well, it's going to be interesting to see what happens if and when it finally is approved or rejected. I think people are worried about a little sell the news either way.
Gotcha. Or you got 45,000 on Bitcoin, so that's a major milestone there for Bitcoin. So again, awaiting an ETF could come regulatory approval in a matter of days. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. X, formerly known as Twitter, is now worth less than a third of the price Elon Musk paid for it. Axios is reporting Fidelity has marked down the value of its shares in the company again and believes it's worth 71.5% less than at the time of purchase. Now, sticking with Musk, his other company, Tesla, delivered more vehicles than expected in the fourth quarter. But it's not all good news. Bloomberg's Ed Ludlow explains.
In the fourth quarter, 484,507 EVs delivered by Tesla. That was ahead of estimates, and it does mean that Tesla exceeded its target of 1.8 million vehicles in 2023. Go back to a year ago, January 2023, the first earnings call of the year, where Elon Musk said that 2 million units would be possible in the full year.
Shares right now, they're down just a fraction. And Tesla also dropped behind China's BYD in global electric car sales. Now, BYD posted a record sales quarter, selling more than 526,000 fully electric vehicles to become the new king of EVs. Now, that was mainly driven by its larger lineup of cheaper models in China. BYD shares in China right now, they're down more than 2.5%. And Rivian missed expectations for quarterly electric vehicle deliveries, even as production ramped up during the past year. The company built 17,541 EVs in the final 3 months of 2023 and delivered nearly 14,000. Now, that delivery shortfall, well, it highlights the challenges that are facing the automaker, particularly in a year of lingering supply chain issues and slowing growth in the EV market. Rivian right now down more than 9.5%. Those are the stories we're following. I'm Lisa Mateo. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's at 21 on Wall Street. I'm Amy Morris with the Bloomberg Business Flash. Market movers in electric vehicles. Tesla delivered more vehicles than expected in the fourth quarter. Not enough to stay ahead of China's BYD. In global electric car sales, Tesla shares fell as much as 1.6%, but they are clawing back now, up more than 0.5% now. Rivian Automotive missed expectations for quarterly electric vehicle deliveries, even as production ramped up during the past year. Rivian shares down nearly 10% at this hour. We check the markets for you all day long here on Bloomberg Radio. S&P down 0.6% or 29 points. NASDAQ down 1.5% or 230 points. The Dow down, Dow's little changed. It's only down 1.4%. Or 1.1 point. Let's get that straight. The 10-year Treasury at 3.93%. The 2-year yield at 4.31%. And NYMEX crude oil has a gain of 0.2% or 15 cents, now trading at $71.81 a barrel. COMEX gold up 0.1% or $2.60. Now at $2,074.50. The euro, 1.0958 against the dollar, and the yen at 141.70. I'm Amy Morris. That's your Bloomberg Business Flash. Paul and Mike.
Hi, Amy Morris. Thank you so much. We appreciate it. Mike Regan, Paul Sweeney, we're live here in the Bloomberg Interactive Broker Studio. We're also streaming live on YouTube. I believe that's the internet. So you head over to youtube.com, search Bloomberg Radio, and that's where you will find us. Mike, I took a look at the 401k, man. I crushed it this year. I'm pretty good at this.
You were in stocks,
investment
I
stuff.
take it.
Yeah.
You were all in?
Throw it all in the index funds.
You didn't
I've been
move
doing
out
that
to
for-
cash?
No, I've been
And,
doing that for 35 years. I don't even think about it. That's kind of my investment horizon, although that's kind of changing as we go along here. But let's talk to somebody who really thinks about it a little bit more deeply than I do. Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence, joins us live here in our Bloomberg Interactive Broker studio. So, Gina, first of all, explain to me what happened from like October 19th to year-end 2023. Wow, we had some big moves in stocks and bonds.
Yeah, I mean, I think a few things happened. First is we were incredibly oversold. Sentiment was very negative. By the end of October, our market pulse index was sitting at panic territory. And it's been pretty good at signaling some near-term wiggles in the equity market, panic to manic, panic to manic. It was really the story of 2023. We hit another panic button by the end of October. At that same time, in the month of October, we started to see the bond market turn over, and I think that was a really big catalyst for stocks, with the surge in yields that we experienced in the third quarter being really painful for equities. The reversal that emerged in the bond market by late October, early November was pretty profound as a driver of risk tolerance in the equity market. And it was off to the races for all markets as we finally got comfortable with the idea that the end is here for hawkish monetary policy. We're likely to move to a much more dovish stance throughout the course of 2024. And that's what markets started to price in the fourth quarter.
You know, Gina, it was another one of those years where it was the huge mega cap growth stocks, you know, the Magnificent Seven or whatever you want to call them, really driving the bus. And I feel like it's been frustrating for sort of old school value investors to watch this happen year after year. There always seems like there's, you know, a dawn coming for value, and value is going to start outperforming. Is this the year for that, do you think?
You know, I think that value actually really started to get its legs all the way back in 2022, and it's a bit of a misnomer that value was a terrible performer last year. It really was about market cap more than anything. When you market cap adjust the value factor, it was a pretty flat year. It wasn't a great year, but it wasn't a horrible year, as you would assume when you don't market cap adjust the value factor. So I think that's something to consider. Also, really from the October lows, small caps have been on a rip as well. So you like to see small caps performing a little well. Value not necessarily, because large caps have been performing also, but certainly lower volatility stocks have underperformed high vol stocks, high leverage stocks have outperformed low leverage stocks. So we are seeing risk tolerance reemerge. Will it be a year for value is a really tough call right now. I mean, I think when you look at the composition of, you know, the value indices versus the growth indices still have the favor of earnings trends. And with policy, sort of the policy impediment going away, it's really tough to make a call for value to be the big outperformer, with the one exception of maybe financials. Inside the value index, you do have a pretty strong representation from the financials segment. And if the yield curve continues to become more upward sloping, that could benefit financials materially. I don't know how much investors are going to embrace that trade because everyone's still quite scared of what's on the books of the banks.
Yeah.
But nonetheless, there is an opportunity there. And if you can get some stabilization in the commodities complex, that could enable the value trade as well.
Gina, I want to talk about earnings. I'm looking just at the S&P 500 and on the Bloomberg terminal. Looks like there's 12% kind-ish type of earnings growth forecast for 2024. How do you feel about that number? Should I consider some earnings risks still out there in the market?
You know, I think what's happening with earnings is really interesting, because if you were purely relying on macro factors to forecast earnings, you would have gotten the last year wrong, completely wrong. It really isn't about macro-driven earnings trends. And I think that this sort of dichotomy between what we talk about all the time, which is the sluggish macro economy, and what's happening in the earnings environment creates a ton of confusion. But what's really driving earnings growth right now is margin improvement. It has very little to do with top-line growth. It has very little to do with some of the broad economic indicators that we're following, with the one exception of inflation. And inflation has been incredibly consequential to determining the earnings outlook over the course of the last 2 years. Inflation's acceleration in 2022 contributed to massive downdraft in earnings expectations and earnings growth. Inflation's deceleration in 2023 became a big tailwind. As long as inflation continues to decelerate, as long as PPI in particular decelerates faster than CPI, you can count on margin improvement to continue to drive some degree of S&P 500 improvement, irrespective of what's going on in the broader macro and broader volume sales environment.
You know, Gina, Paul was talking earlier about how many rate cuts are actually priced into the short-term interest rate market. No one seems to really believe we'll get 6 rate cuts as the current pricing suggests. What does that mean for the equity market if there is, start to get some disappointment from the Fed speakers to not expect that much easing?
Yeah, this goes back to something we were talking about a little bit earlier, and that is the yield curve going to continue to upwardly steepen? Because that's where you see the risk emanate or sort of work its way into the equity market, is if the yield curve doesn't behave as anticipated, then you start to see much more equity market sort of weakness potentially emerge. So the question becomes, how much of that rate cut is priced into the short end versus the long end? What's the term premium we're looking at today, which is a whole nother set of questions that we need to answer. I would say it is a risk going into this year, but it's nothing like the risk of, oh my gosh, the Fed has to tighten 5 times, which we faced at the beginning of 2022. And I think that's a really significant point to be made, is the risk of the Fed not quite doing as much as we hoped is very different than the risk of the Fed really pushing the brakes on the economy, which is a very different environment. So I think in nuance, it means that we could have a lot of wiggles. It could be a choppier market than many are anticipating. It certainly is not a market that looks exactly like the fourth quarter of 2023, which was almost idyllic.
Yeah, not many do, right?
We're not going to have the perfect environment to merge. It's probably a much choppier environment through the next four quarters or so, as we contend with a Fed that is going to be on again, off again, and really much more data dependent perhaps than the market is anticipating.
Get a little technical here. Breadth in the market. It was terrible, arguably, for the first 9 months of 2023, the Magnificent Seven. It seemed to get better there during that year-end rally. We had the Russell, outperform. We had even if you look at the S&P equal weighted, that outperformed the SPX. So it looks like the breadth kind of got better in that fourth quarter. Is it where we want to see it today?
It's a lot better. It might actually be a little overbought
really? Okay.
at this point in time. And so I hate to be the bearer of bad news or anything. But when you get to a point where more than 75% of stocks are trading above their 50-day moving average, where RSIs are surging above 80, which is where we were by the end of December, it usually is a point that triggers some degree of consolidation in the equity market. We're already seeing that at the start of this year. So we got a bit overbought on breadth. I don't want to put too much cold water on it because, of course, we want more participation to ultimately fuel the market's gains. And seeing more participation across the world as well as into lower caps is a very good thing for the equity market's longer-term trend durability. But in the short run, it probably does indicate that we're a little too overbought and we're due for some consolidation.
You know, Gina, it's a time of year where a lot of the old seasonality tropes get trotted out dependably and reliably, as goes January, as goes the rest of the year. Some people just look at the first week and believe that that's a sign of where we're going for the year. Are you a buyer of any of that?
Not hugely. I mean, of course, if you have a great January, you've got 1 month under your belt, and so it means that 1 month out of 12 is positive, and so the math works in your favor a little bit. So if we do have a pretty positive January, generally that indicates that your year is more likely to be positive. I think we have to be a little bit more conscientious about short-term changes and shifts in the broader macro as well as in the earnings landscape, and those tend to dominate a lot more of my thought process. I do think that after the incredible surge we had in the fourth quarter, we're due for consolidation, but broadly, all of the trends are still very supportive of stocks and really have been since late 2022. It won't be a perfect climb higher, but it is worth noting that participation is great. We want to see this. Some improvement in momentum is a positive thing. And none of these things are things that we want to fade over the long run.
What's the status of University of Florida football?
Oh, God. Do we have to go there? I mean, secretly, I was really excited to see Michigan beat Alabama yesterday.
Right.
So this is the depths of my despair as I'm now looking at other teams because my team is no longer in the run. It's been a rough couple of years.
Any optimism down there?
I don't know. I would like to say yes, but it's not looking great.
More optimistic about the market than the Gators, it sounds like.
Yeah, I'll stay with that. That'll work for me.
Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence and a proud graduate of the University of Florida. S&P 500, we're off about 0.8% here. The NASDAQ off 1.8%. We note that the Russell, we're just talking about breadth, the Russell's doing a little bit better, only down about 0.25%. With our news in New York City, here's Michael Barr.
Thank you very much, Paul and Mike. The search continues for survivors in the rubble after a series of powerful earthquakes hit western Japan, leaving at least 48 people dead and damaging thousands of buildings, vehicles, and boats. Officials are warning people in some areas today to stay away from their homes because of a risk of more strong quakes. The Biden administration has won another battle in its effort to try and slow China from building its own semiconductor industry. Bloomberg's Ed Baxter reports.
ASML Holding has canceled shipments of some of its machines to China at the Biden request. This week's before the export bans on the high-end chip making came into effect. The Dutch manufacturer had licenses to ship 3 top-of-the-line deep ultraviolet lithography machines, but before the deadline, it decided to cancel the orders. The U.S. and allies have been trying to block access to the technology. Ed Baxter, Bloomberg Radio.
A missing 17-year-old Chinese exchange student has been found safe by police in Utah, camping out in the woods, cold and alone. He had been reported kidnapped by his family in China after they paid a ransom demand of $80,000. It turns out it was a scam known as cyber kidnapping, in which kidnappers target foreign exchange students and order them to isolate to make themselves appear to be held captive in an attempt to extort ransom money. Authorities say victims comply out of fear their families will be harmed. Brandon Amacher is a cybersecurity expert and instructor at Utah Valley University.
Actors are able to manipulate both a victim and their family into believing that something has happened to the victim.
Authorities are tracking the so-called cyber kidnappers to catch them. It will be Michigan versus Washington for college football's national championship. The Huskies won the Sugar Bowl. The Wolverines won the Rose Bowl. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. I'm Amy Morris with the Bloomberg Business Flash. Tesla delivered more vehicles than expected in the fourth quarter. Not enough for the Elon Musk-led company to stay ahead of China's BYD in global electric car sales. Bloomberg's Ed Ludlow says Tesla handed over 484,507 vehicles in the last 3 months, about 42,000 less than China's BYD.
BYD, the Chinese EV maker, delivered 526,409,000 EVs in the quarter gone, meaning it now holds the crown as the standalone biggest maker and seller of electric vehicles. And of course, it has many more cheaper model variants in that domestic Chinese market.
Bloomberg's Ed Ludlow. Tesla shares now down 0.3%. Barclays cut Apple to underweight for the first time since 2019. Apple shares down 3.5%. We check the markets for you all day long here on Bloomberg Radio. S&P down 0.7% or 37 points. NASDAQ down 1.8% or 274 points. The Dow down a fraction, down 14 points. And the 10-year Treasury at 3.93%. The 2-year yield at 4.32%. NYMEX crude oil, a gain of 0.5% or 35 cents, now trading at $72 a barrel. COMEX gold is at $2,066.70 per ounce, and that's a drop of $5. The euro at 1.0951 against the dollar. The yen at 141.92. I'm Amy Morris. That's your Bloomberg Business Flash. Paul and Matt, or Paul and Mike.
That's right. Amy Morris, thank you so much. We appreciate it. Mike Regan, Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio. I have no idea where Matt Miller is, something about paternity leave, so no need to worry there. We're also streaming on YouTube, so head over to youtube.com. Search Bloomberg Radio, and that's where you'll find us. Let's talk global commodities. I need the outlook for 2024. I'm just looking at my Bitcoin. It's up 3.8% today, over $45,000 per token. And Mike, you're telling me that's because there might be a spot ETF announcement in the coming days?
Yeah, they have a deadline to approve or reject one of the funds, Kathy Wood's fund that she's involved with, by January 10th. Okay. So, you know, the thinking is it'll be a yes. A lot of people believe it will be a yes. The SEC lost a lawsuit against Grayscale in their effort to convert their fund into an ETF. But I don't think everyone's convinced. You know, there's a lot of options, puts in the market right around that date. So there's a lot of tension about whether or not, you know, we will really see, finally, after more than a decade. Remember, the Winklevoss twins, more than a decade ago, were the first to apply, and the SEC's been pushing back ever since, but we'll see.
All right, let's talk a little Bitcoin, talk a little bit broader commodity discussion. We do that with Mike McGlone. He's a senior macro strategist for Bloomberg Intelligence, manning our Miami Beach office. Mike, so of this move higher in Bitcoin, how much, from your perspective, is kind of that technical, I guess, I don't know what it's called, just the whole ETF-driven issue as opposed to maybe some more different fundamentals?
Well, thank you for bringing me on for this one, because it reminds me of the word I learned from Bitcoin people called hopium, H-O-P-I-U-M. It's just so much opium. And Michael pointed out, it's just the known knowns are quite extraordinary, but they're known knowns. That is, we're going to have a halving in a few months. They're going to cut supply. ETFs are going to be launched, and global adoption is picking up. But get that, the market's rallied quite a bit from last year. It ended around 15,000, 2022, and now we're at 45. It just, to me, getting a little bit extreme here, overbought, I guess is one word to use it. But the key thing to look at it is Bitcoin is still very much a risk asset. It trades about 2 times the volatility of the NASDAQ. And all risk assets were down a lot in 22. They're all up in 23. Last year, Bitcoin was the leader. So to me, the risk is we've priced in so much upside and so much known knowns that it tilts back downward. I think the bigger risk is the macro. If you see more of what's happening in the stock market today, just a little bit of reversion last year, this year, then Bitcoin, the world's most significant 24/7 trading risk asset, leading indicator, is going to have a problem going up.
You know, Mike, as important and as Bitcoin is, and we all love to talk about it, arguably the regular commodities, the old school commodities are more important and more in your wheelhouse. Yeah. You look at the main Bloomberg Commodity Index, it was down a decent amount last year. Part of the sort of, subsiding of inflation that we saw during the year What are you thinking about for 2024 as for commodities as a whole and sort of the big ones, your gold and your oil?
More deflation is a risk for broad commodities. So let's start with oil. I think people need, if they want someone to blame by the end of the year, I think we're going to see a 40 handle on crude oil this year, getting towards $40 a barrel. That's a normal retracement. That's what it's been doing since it peaked at 40 in 1990 when Saddam Hussein invaded Kuwait. And it's heading that way. A lot of it's just the supply and demand factors are so unfavorable for crude oil from what's really driven it the last 10 years. And I like to point out is total excess of U.S. and Canada supply over demand in terms of liquid fuels, crude oil, ethanol, and everything is running around 6 million barrels a day. That about matches OPEC's spare capacity. They're both rising rapidly. So we're seeing, and also there's issues with China. So I think it's going to do what it normally does, head near there. And today we saw a little bit boost from geopolitical events, but those are having diminishing returns. Like crude oil peaked last year around $95 a barrel the week before Hamas invaded Israel. Now that's a good sign of a peak. It's just not going up on increasing geopolitical events, and I think it needs to get cheap to really shut down that excess of supply into the U.S. And Canada. And the demand's also declining. The key thing is also China. When you hear about OPEC cuts, they're hurting China the most because China is their largest importer. And China, we know, is you look at just in Bloomberg Terminal, I type in BI China or NI China every day, and they're just so negative on China. I see China more of an issue pressuring crude lower. But the key thing I'll point out is, and as Paul likes to remind me, and I appreciate him reminding, is I still see gold heading higher versus all commodities. So here's the bottom lines. Commodities are deflating in prices with the exception of crude oil. And the way to end this is I look at this year as the U.S. stock market absolutely has to go up or commodities will continue deflating. We'll see a pretty severe deflation on the back of all that significant inflation we saw to the peak of in 2022.
Do you think gold outperforms like the S&P 500?
Well, it's a good chance it does. So I think gold is a little more of a put on the S&P 500 this year, Paul. If the S&P 500 starts trickling down, let's just say it drops back 5% this year. That is a lot more reason for the Fed to ease. It's a severe deflationary force, and that just accelerates gold. And the bottom line for gold is it's at an all-time high. They're very near it, and it has the deepest pockets on the planet have been buying gold, and that's central banks. I don't see them stopping, particularly as we see this issue a lot of countries trying to run away from the dollar. I mean, I don't think that's going to happen so much, but gold is the only logical alternative from a U.S. dollar. Any other fiat currency is nowhere close to the foundation that the U.S. dollar has on a global basis and the high rates.
I keep thinking about that $40 a barrel oil. Wow, that would get us to what, about $2 a gallon in gasoline? Is that a good story for risk assets and the economy, or is that going to coincide with a bad story?
I think it's more likely to be part of how about so much bad, just a little bit of reversion of last year. And, Michael, the key way to guide us to crude oil is very much not profound if you look at natural gas. The price of natural gas right now is $2.55 per MMBTU, was first traded in 1990. That's 34 years ago. That's severe deflation. And that's the #1 source for heat, electricity, and fertilizer in this country. And there's this country, we're just a natural, we're complete net exporter now of crude oil. And the world, OPEC has a problem. And that's just mainly because of rapidly advancing technology, demographic shifts. And the key question is, what stops that? Typically, it takes lower prices. So that's what I see. Crude oil basically needs lower prices to shut off this excess of supply coming out of the U.S.
Mike, I mean, are we hearing any of the U.S. energy producers saying they would cut the production of oil now that we've become such a net exporter?
I haven't heard that, but it's the way it's always happened. I like to watch the metric I've been watching I created last year was if you combine the excess of supply in U.S. Canada with the spare capacity from OPEC, that's 12% of global production. Just, when crude oil peaked in 2008, it was a deficit of 10%. So they don't really say it so much, but it usually happens. It usually takes lower prices to curtail that supply. And that's been the case virtually every collapse in crude oil we've had starting in 2008. And that's when, the U.S. was still a net importer. So you basically need those lower prices. And the key thing I like to remind us is the Russia's invasion of Ukraine just accelerated the elasticity of supply and demand forces in commodities. And you like to bring this up a lot in corn. Paul, corn peaked around $8 a bushel. Now it's $4.65, and it might be heading towards $4. Right. That's just normal supply because now we have a major excess of corn in this country.
Yep. Mike McGlone, always the best. Senior macro strategist covering all of the commodities for Bloomberg Intelligence, heralding and manning our desk in Miami, Florida. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. Sources tell Bloomberg ASML Holding canceled shipments of some of its machines to China at the request of the Biden administration. Now, it comes just weeks before export bans on the high-end chip-making equipment came into effect. Bloomberg's Sarah Jacob has that backstory.
U.S. National Security Advisor Jake Sullivan contacted Dutch government officials late last year about the same matter, and the Dutch officials asked him to contact ASML directly about these machines. And these machines are called immersion deep ultraviolet lithography machines. The Dutch government then partially revoked licenses recently for the shipment of certain advanced machines to China, and that's affected a small number of customers there.
Now, ASML ADRs right now, they're down about 4%. Analysts at Barclays expect softer demand for Apple's latest iPhone and are downgrading the stock because of it. We get more from Bloomberg's Abigail Doolittle.
Analyst Timothy Long saying that channel checks show that demand for the iPhone 15 lackluster, expecting the same could be true for the iPhone 16. In addition, he does not expect services to grow more than 10%. And he's saying that there's not a quote-unquote bounce back for the Mac, iPad, and wearables.
Now, it's the first time Barclays cut Apple to underweight since 2019. Apple shares right now, they're down more than 3.5%. And DoorDash is looking to expand beyond just delivering restaurant meals. Its chief executive tells the Financial Times the company plans to move more into